Burger in London, and here are your top stories. The BOE bounce fades. The global bond rally continues as the rally from stocks fades with the Bank of England. All of that creating a fizzle with futures and treasuries declining. The credibility question, the UK government steps up efforts to build confidence after its disastrous mini budget. But there's no U-turn in sight. The pound rebound snaps. Plus, turbocharged Porsche defies market gloom as it revs up for the biggest European IPO in a decade. So futures really unable to keep any of those gains. Yesterday, we had some hot regional German inflation coming in. That made us concentrate yet again on the higher inflation, lower risk story. So here are futures down by at least 0.3% for the DAX. So we're just getting markets opening up. Now let's check in on them as, again, some of those reversals we saw from yesterday starting to fade. A lot of it perhaps were stop losses to the bearish side, meaning that everything rose except for the dollar. So that allowed things like commodities to do better yesterday. But again, today we don't have that catalyst, of course, of the BOE stepping in and buying long end bonds. So what are we seeing? UK FTSE 100 markets opening, cash markets down 0.6%. Spain is down 0.6% as well. Now, to that point, we are getting some breaking figures on prelim CPI for Spain. It's coming in under the estimate, 9.3% year over year. The estimate had been for 10%. So perhaps a little bit hotter in Germany, but not as hot in Spain. Still, it does seem like the trend, the direction is one of risk off yet again. France, those opening up down 0.4%. Here's your cross asset picture. U.S. futures on the lows of the morning. They were basically unchanged. And again, it's the dollar strength story that is coming back. We had dollar weakness yesterday, and again, that really allowed this monumental rally. The S&P did better, treasuries did better, commodities did better, all of that resulting in the best cross-asset rally since 2020. But again, we're looking at a weaker pound. That's at 108.08. If we don't have fair value in the gilt market, does that mean that all the pressure then stems to sterling? Certainly seeing it dropping 0.7%. And finally, 10-year yields, those higher by nearly 10 basis points. I mean, it has been a wild ride. At this point yesterday, before the BOE stepped in, 10-year yields were up at 4%. We're at 3.8 now. So it definitely has dropped a lot. But again, it's climbing yet again, considering what we saw yesterday was just sort of this mechanical reaction to a Bank of England that was stepping in to save pensions experiencing some pretty major stop losses. So it feels like we're going from VAR shock to VAR shock. Let's get over to our Bloomberg MLive managing editor, Mark Cudmore. And Mark, I really am trying to wrap my head around where we go from here. So what smart chart have you brought us to help us figure it out?
Good morning, Danny. I can't promise a smart chart, but I can promise you an interesting chart and a bit of a view. So yesterday, the Bank of England treated the symptom, the risk of the meltdown of the entire pension system in the UK, a systemic risk there. So that's what they dealt with. But they did not deal with the underlying problem. And this is the underlying problem, the UK's current account deficit. Now, the red bar is the forecast of where it's expected to print tomorrow. That'll be the second quarter data. The first quarter data was already a record. You can see, just smashed the previous record, 8.3% of GDP. And tomorrow, It is a volatile number. Estimates vary, but roughly around 7% of GDP where we come in. It's likely to be the second worst number on record. But I note it could be record. It may not be the second worst. It may even be a new record. It is definitely a terrible situation for the UK. They cannot fund their situation. Now, the UK is now an emerging market economy, or a submerging market economy. As someone who traded emerging markets for many years, and particularly two countries that had perennial current account deficit risks, both Turkey and South Africa, there's only one way this ends. It's a credibility issue. It ends with either the currency weakening substantially or yields going up substantially, or in most cases, both those things will happen. And that's an important dynamic here, that once you become more like an emerging market, it's not that rising yields support your currency, it's that rising yields show that people are selling your bonds and they're also getting out of your currency, getting out of your assets. And that is the world we're now in with the UK, where as yields rise, the UK will actually sink further because there's a loss of faith in the country. When does it end? It ends when probably either the government or the Bank of England concede and make some kind of action to appease the market. Perhaps both of them do so. How long does that play out? I don't think we're going to get all the way to November, but let's see. In the interim, though, I do think that sterling has a lot of downside in the coming months, unfortunately, until those yields go much higher from the Bank of England.
Yeah, fair enough. I mean, how much damage do we need to see mass exodus of that market of gilts before we finally have a yield that can entice people in? Mark, thanks. Great stuff as always. Bloomberg MLive Managing Editor Mark Cudmore. And of course, we do have the gilt market now open, and we have resumed to selling. The selling pressure is most acute in the long end. 10-year yields, those higher by 10 basis points. 30-year yield, I got to say, I mean, it's pretty bad across the curve. Of course, 10 basis points, look, that's a big move, but considering we saw over 100 basis points in 30-year yields of a drop yesterday, it's not that much in comparison, but still it really exemplifies that the pressure is still on. This is still a market that wants to sell gilt yields. And of course, what does this mean for pensions? They had a lot of stop losses, perhaps something damaging enough that the BOE had to step in, but just perhaps kicking the can down the road. Of course, they still say they'll do QT at the end of October, so the bond vigilantes may be willing to test them. So the belly of the curve under the most pressure. We also have some lines coming in from Prime Minister Liz Truss, who is currently speaking in a BBC interview. Now, she says that the government had to take decisive action, and she's prepared to take controversial decisions. So this sounds like someone who certainly is not going to U-turn. Also saying that people, businesses are protected from higher fuel bills, and that currencies are under pressure around the world. So again, this idea that it's not just the pound, it's a strong dollar pressuring everything. She also said that they are working closely with the Bank of England. Of course, this is a statement the Treasury put out yesterday. We know the Treasury and the BOE are now having daily meetings. The Treasury yesterday also emphasizing the independence of the Bank of England. Just want to pause here. Some more lines coming through from Liz Truss in this interview saying that we are putting the country on a better trajectory for the long term. Again, this is Prime Minister Liz Truss speaking in a BBC interview saying that growth won't come overnight for the UK. Again, she really is emphasizing here what she's doing. The government had to take decisive action, and she is prepared to take controversial decisions, and her plans ensure people will pay lower taxes. Well, let's get straight to our very own Lizzie Burden, who at the moment is outside the Bank of England. Lizzie, thanks so much for joining us. I mean, look, we have these lines coming from Liz Truss saying that the UK is facing very difficult economic times. I mean, this does not sound like a prime minister who's willing or will back off of the policy that she's set forth.
No, and that's the same message that her junior ministers have been giving in the broadcast interviews. Truss digging in, and she seems to be resisting the calls to sack her Chancellor, Kwasi Kwarteng. Of course, he's a close personal friend and her political soulmate. So it would be a huge humiliation to get rid of him, and nothing much would change anyway. There had been pressure to U-turn on the tax cuts, but the message, as you say, from Truss is that these plans are going to grow the economy and that every major economy in the world is facing the same blowback from markets. Well, that isn't going to wash. The International Monetary Fund has specifically named the UK's fiscal plans as problematic. The US even is criticising them. You've just heard from Mark Carney, the former governor of the Bank of England, saying that the government is undermining the UK's economic institutions. So you're exactly right. It is a credibility question, and it's also a credibility question for the Bank of England, because while stepping in with quantitative easing was a financial policy measure to stop the gilt market spiralling out of control, at the same time, the chief economist of the BOE, Hugh Pill, earlier in the week said that we can expect a significant rate hike in November. So the Bank of England looks like not only is it confused, but it's beholden to fiscal policy. A difficult time for UK economic policy on both sides.
Indeed, Lizzie, thank you so much. Bloomberg's Lizzie Burden there outside of Threadneedle Street. Well, let's get now to Mark Dowding, CIO at Blue Bay Asset Management, who for some time now has been calling this bearish sterling bet. Mark, I mean, very prescient. You know, to some degree, sterling saved a bit yesterday from the BOE, but are you surprised we didn't see more declines, or we haven't seen more declines towards something like parity yet?
So I think the thing to really point out here is, I mean, as mentioned earlier, we're in a situation where you either control where the pound goes or where interest rate goes. And ultimately, I do think the pound is going to be moving weaker here. Fundamentally, the other thing which is a real issue is around interest rates. This mini budget was designed to boost growth, but if we end up with mortgage rates going dramatically higher, it could end up having the reverse effect. Personally, I think that an intermeeting hike is going to be very unlikely. I do think that if you end up with the Bank of England needing to go to an intermeeting hike, you're probably looking at a loss of confidence in the Truss government at that particular point in time. So clearly this is a very difficult situation, but I think the sober economic analysis in terms of inflation, it probably isn't enough at this stage to cause the Bank of England to need to step in and jump to an intermeeting rate hike. So for me, I think the pressure on the pound will sort of come back. We will be sort of sliding back towards parity. But ultimately, for me, I just don't think you can deliver the amount of rate hikes that are currently priced in the market. If you go to 6.5, you're going to be killing mortgages, killing the housing market.
Yes, Mark, I wanted to go exactly there, because the UK does have this unique situation where a lot of debt mortgages are tied to this rate market. They're floating rate. So the market pricing in some 150 basis points worth of hikes, you say, look, they can't do that given what it would do to the mortgage market. So how hamstrung is the BOE at this point then, Mark, to help fight inflation, to put the economy on the right course?
Well, I think the irony here is actually some of the measures that have been announced are actually helping to actually mitigate inflation in the short term. So the measures to cap energy prices led us to revise our projections on inflation from a peak of above 18% back down to around 11 or 12%. So although we've done some steps that are lifting inflation back up a little bit again, that's more of a medium-term effect. But I think that ultimately the UK has got to face a choice. Either you're going to have a nasty recession and high rates and a collapsing housing market, or you're going to end up sort of choosing which is the lesser of the different evils here. And ultimately, the Bank of England may end up needing to be prepared to tolerate a weaker pound and a longer inflation overshoot than otherwise would have been the case. But in a way, there isn't really an easy way out.
Mark, what are you doing in this gilt market? Remarkable rates of change we've seen. How are you positioning?
So as well as being short the pound, we've been sort of very bearish on gilts. We think the long-dated gilt yield should rise because the medium-term sort of risk premium on UK assets needs to go up. We also think longer-term inflation expectations will continue to be elevated in the UK. But against that sort of bearish position in gilts, we're actually now more inclined to be bullish at the very front end. December SONIA is pricing in 5%. We're currently at 2.25%. I just don't think you can do that to mortgage rates without bringing down the government. So I don't think the Bank of England can deliver what is being priced in.
Okay, Mark, stick around with us. Definitely have much more to cover with you. Mark Dowding there, CIO at Blue Bay Asset Management. Coming up, the wait is over. Europe finally has a blockbuster IPO. We're live with Tom McKenzie over at the Frankfurt Stock Exchange. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Policy, politics, from the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
Welcome back to the Open. About 15 minutes into your European trading day, and the losses resume. More than 1% on the wider benchmark index. Some of the worst losses occurring there in the FTSE 100, down 1 1/3%. Though we are seeing not as bad of declines in sterling today, down 0.8%. It has been down more. We're also getting Porsche opening up at the moment, opening up at 84 euros. It had been priced less than that at 82.5 euros. So we are getting a bit of that IPO pop, and Europe has been waiting for this. It's been waiting for a blockbuster IPO, and here we are. We finally have it. It's, of course, trading on the Frankfurt Stock Exchange, again, opening up to 82 euros and 50 cents. Parent company Volkswagen went for top pricing, of course, despite the market turmoil. And we're going to have Tom McKenzie speaking with the CFOs of Porsche and VW, but he joins us now at the Frankfurt Stock Exchange. So Tom, at least the initial open is to the upside. What does this IPO mean for Porsche and VW?
Yeah, Danny, there you go. As you said, a little bit of a pop then on the price. They priced it at the top of the range. 82.50 was the price. You're getting, what, 83, 84 euros in terms of the trade right now. They're going to be ringing the bell inside the Frankfurt Bourse as I speak. And a historic day for Porsche, the listing today, an historic day for European IPOs as well. This is going to be number 5 in terms of the largest IPOs out of Europe ever. And it's certainly one of the largest in German history books. So they're going to raise, it's going to be valued now a little over 75 billion euros. The cornerstone investors, the likes of the Norwegian Sovereign Wealth Fund, the Qatari Sovereign Wealth Fund, they'd ensured that this was going to be pretty likely a successful IPO, which is what was being reflected in the pricing today. They're going to raise then about 9.4 billion euros for the full Volkswagen Group, which still has a 75% stake in Porsche. And they're going to use that money around electrification, around digitalization, software, as well as handing some of it back in terms of a dividend. Around the concerns of this, and analysts have flagged a few concerns. One is governance, because you have the CEO of Volkswagen, Mr. Oliver Blume, who is also the CEO of Porsche, and the structure as well in terms of the non-voting and the voting shares is also something of a concern. There's going to be scrutiny on this company in terms of how quickly they can electrify some of these sports brands that are so iconic, like the 911, like the Boxster, the Roadsters, but also the SUVs as well that have been selling so well. And the question is whether they can meet that revenue target they've set themselves for this year. Very ambitious, arguably, 39 billion euros with a return on sales of about 18% in an environment where it's recessionary. The ticker is P911, Danny. They issued 911 million shares, a bit of upside in the first few minutes.
It's like they have a car called the 911 or something. Tom, great stuff as always. Of course, we're going to hear from Tom later this hour. He's going to have one of the first interviews with the CFOs of Porsche and VW, just pointing out, losing a little bit of steam. We are now looking at just a rise of 0.2% for that IPO. Well, certainly a lot of market volatility to be IPOing into. Let's bring back in Mark Dowding, CIO at Blue Bay Asset Management. And Mark, when it goes to volatility of this market, it's not just stocks, of course. I'm looking at something like a treasury market where liquidity has just been absolutely sapped. Is this a dysfunctioning market? Is something broken at this point?
Well, I would say that in the last couple of days, the UK market has been particularly broken. And obviously the UK is a large market. And so it's been a market that's actually having ramifications in terms of what we're seeing elsewhere. We've seen in the past, for example, hedge funds like LTCM blow up and how a hedge fund blowing up can have big market implications. In some respects, we've seen a bit of a detonation of UK sort of public finances and the trust in them, detonating the pension fund industry in the context of the UK. So it is something that's going to have global ramifications, both for volatility and also for liquidity.
Mark, Blue Bay, of course, is known for many of its emerging market trades as well. Much has been made about this idea that the UK market is trading like an EM market. So in a world where you have weaker currency, higher yields, concerns in terms of trade shock, what's your playbook for how this plays out? Again, putting that EM lens onto this market.
Yeah, I mean, sometimes it's almost tempting to call it the Great British Peso, isn't it, in terms of the ticker GBP. But I would say that in terms of the hyperbola, I would sort of emphasize that the UK isn't an emerging market. We do have a lot of domestic savings. This is a very wealthy country. So although some of the behavior we're seeing is EM-esque, I still think there's a lot of differentiation between sort of what we see in emerging market countries compared to what we're seeing here in the UK. Albeit some of the sort of policy stance and the approach to conducting policy does seem to be a bit more reminiscent of what we see in terms of less developed countries.
Mark, the Great British Peso, that's unfair. The peso has gained against the dollar. It's done very well. So certainly not maybe the peso, but again, I do think it's interesting, that idea of putting the EM lens on. Mark, thank you so much for joining us this morning. We really appreciate your time. Mark Dowding there, CIO at Blue Bay Asset Management. Now coming up, Liz Truss says she's prepared to make controversial decisions as the UK pushes ahead with its embattled economic program. This is Bloomberg.
of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan's society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the Open. About 24 minutes into your European trading day, and it is a reversal. We saw an everything rally yesterday. Equities move higher, but it is yet again turning into a day of ugliness. Declines of more than 1%. You're also looking at a gilt market that is also under pressure as well. Yields up more than 10 basis points across the curve. It does look like the belly of the curve taking the biggest of the beating. But again, this was after we saw the long end, for example, drop more than 100 basis points. Now, when it comes to these movers, again, it is this type of market where the macro is in control. Now, that was bringing into doubt whether Porsche would be able to IPO. They have indeed. They've, of course, chosen today. Finally, the big mega IPO Europe has been waiting for. We did see larger gains. At one point, it was at 84 euros. It's come back down to around where it IPO'd, up just 0.1%. Now, when it comes to the macro struggles, markets right now pricing in nearly 160 basis points worth of rate hikes from the BOE. There's this concern of what this will do to the housing market because the UK has so many floating rate mortgages. If you hike rates, will that crash the housing market? So Barrett, one of the home developers, down nearly 9%. And next, the clothing retailer warning, cutting their outlook on UK inflation. All right, let's get to the Bloomberg Business Flash now. With that is Laura Wright. Good morning, Laura.
Good morning, Danny. H&M says it will cut costs by $180 million a year after earnings slumped at the low-cost clothes retailer. Adjusted operating profit in the latest quarter came in well below estimates on higher garment and transport costs and following the Swedish company's exit from Russia. Amazon has announced a pay rise for hourly workers in the United States. It says the average starting wage for most frontline staff in warehousing and transportation will increase to more than $19 an hour, a move costing around $1 billion a year. Earlier, Bloomberg reported that Amazon is encouraging some U.S. call centers to work from home to cut office costs. Total Energies may sell parts of its 20% stake in Adani Green Energy. That stake was worth about $10 billion at the end of August. The CEO, Patrick Pouyanné, says it's holding the company is a source of potential cash and its balance sheet is safe. That's the Bloomberg Business Flash. Danny.
Laura, thank you so much. Laura right here in London. Coming up, Liz Truss, and speaking to the BBC, says her economic plan is the right plan for the UK, saying that she's happy to pursue unconventional, unpopular policy. This, of course, after the BOE's dramatic intervention in the gilt market in an effort to help avoid any big ruptures in this market, especially when it comes to pension selling. Though losses in this market continue after yesterday's rally, losses of more than 1% for most of these indexes. Also looking at gilts resuming their decline. Yields move higher with sterling weakness, cable down by more than 1%. We're going to have more on this next for you. This is Bloomberg.
700th anniversary of Dante Alighieri's death has triggered the work of many institutions and offered a very rich schedule of events. Today in Santa Croce, we present one of these projects that suffered a difficult start because COVID-19 has stopped the project that was shared by the Opera di Santi Croce by the Franciscan community from Florence municipality and the Fund for Religious Building of the Internal Minister. Today, Felice Limosani's project is finally enjoyable. In the Pazzi Chapel, the marvelous architecture by Filippo Brunelleschi, the most important images from the Divine Comedy created by the French illustrator Gustave Doré. Through these images, we can live the violent emotions of hell, the weight of purgatory, and the sublime joy of paradise.
The digital humanities are a cultural occasion to exploit. Summing up, it's about merging humanistic disciplines with new technologies. I find this to be an innovating and modern tool to update culture. Cultural heritage becomes something to hand over to the new generations and not to be put aside. So it's about using technology, pixels, and binary code with a human and humanizing content.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to The Open. 30 minutes into your European trading day, here are your top stories. The BOE bounce fades. Global bond rally from stocks to bonds ignited by the Bank of England fizzles as European equities and treasuries decline. The credibility question, the UK government steps up efforts to build confidence after its disastrous mini-budget, but there's no U-turn in sight. The pound rebound snaps. Plus, turbocharged Porsche starts trading flat as part of the biggest European IPO in a decade. So 30 minutes into the trading day, you are looking at the sell-off resuming. Again, you had the BOE stepping in, buying long-term bonds yesterday in order to help prevent perhaps further damage to this market. But without that reflex, without perhaps stop losses that cause bearish bets to blow up, for everyone to buy, we are seeing a resumption of falls. Stocks Europe 600 down 1.6%, and every single sector is in the red this morning. Not a single one is moving higher. The best performing one is energy, but even that is down 0.9%. Autos, retailers, those really consumer sensitive sectors, the cyclical ones, those are what's under pressure today, as well as financial services and construction. Of course, we're considering a Bank of England, or at least the market is pricing in a Bank of England hiking 150 basis points. Can they really do that considering the damage to the mortgage market? You certainly are seeing home builders under pressure. Of course, they had yesterday a dramatic intervention by the BOE. It did serve, at least yesterday, to calm what could be described as panic in the gilt market. Certainly some concerns about margin calls, notably with pension funds, but with more bond purchases to come and quantitative tightening delayed, has the turmoil forced the BOE to bite off more than it can chew, simply putting off the UK's day of reckoning. Now we're going to try to walk through all of this, and to help us do that, put the events of the past 24 hours into perspective. We've got a panel of experts. We've got Imogen Bankra, head of UK rate strategy at NatWest, Dan Mikulski's lead investment advisor at LCP, one of the UK's top pension advisories, and also Andrew Sentence, senior advisor at Cambridge Econometrics and former member of the Bank of England's Monetary Policy Committee. And Dan, I do want to start with you because some of the issues yesterday, sort of the chaos, if you will, really centering around sort of this idea. So I'm backing up here a bit. Let me focus it on you guys, not me. So really centering around this idea of pensions under turmoil. How bad did it get? How at risk were we from seeing some form of catastrophe with these margin calls coming from pensions?
Yeah, hi there. Great to be with you. Thanks very much. And really, the issue this week was the speed of the move higher in gilt yields, which is what has caught people by surprise, and the implication that's had for the timescales on which pension funds needed to move their assets around in order to satisfy some of these collateral calls. But I think to understand some of this, you've got to take a little bit of a step back and understand why pension schemes were doing these programs in the first place. And all that sort of started around about 20 years ago with pension schemes wanting to hedge some of the sensitivity of their deficits to bond yields. So these programs have been in place for many years, worked pretty well through the financial crisis, worked well through the QE period, worked well through COVID, and have really played a big role in stabilizing pension scheme funding positions for most of the last decade or so. But the implications this week with the speed in movement in those yields higher is what's been the big problem.
Okay, so Andrew, let me take this to you then, because if that's what was at stake of these margin calls coming again from pensions, was it the right thing? Is what the BOE, Andrew, did the right thing to step in and buy long-term bonds to try to calm this market?
Well, they were acting under the financial stability part of their remit, and they acted under that quite a lot during the global financial crisis. And the justification was that the markets were getting disorderly. They were bond yields were rising, and therefore the value of bonds was falling sharply. So the bank decided that they would make some purchases of bonds to stabilise the market, which seems to have worked to some degree, though it's very much a short-term measure. It still leaves bond yields quite a bit higher than they would have otherwise have been and where they were a couple of weeks ago.
Yeah, I mean, Imogen, let me take this idea to you that Andrew is talking about, that this is a short-term fix, that if anything, we're still getting QT. They say it's going to happen October 31st. So what does this mean? Are we not just going to get another retest of the bond vigilantes trying to come in and send gilt yields higher?
Well, I think what it means is that gilts are still on a path towards higher yields, but perhaps the journey to get to that higher yield level is just a bit less volatile and perhaps a bit more measured than the market's moves that we've seen in the last couple of days. You know, I don't think this Bank of England operations fundamentally changes the outlook for gilt yields. The maximum they're buying each day is 5 billion. So they only bought 1 billion yesterday, which leaves them just about 60 billion left of maximum purchases over the next 2 weeks, which doesn't even fully offset the balance sheet rundown that they're planning from when they do actually start QT. So from a kind of net supply perspective, in terms of how much duration is actually going to be left for private investors to take down in the gilt market over the next 12 months, this doesn't change the picture significantly. What was really driving gilt yields higher isn't the prospect of the Bank of England starting QT, quantitative tightening. It was this kind of fiscal issuance that's about to come on board and how much supply of gilts we're going to get over the next 2 years. The Bank of England doing small operations for the next 2 weeks doesn't change that. So I think, we saw yesterday it introduced some composure back into markets and it kind of halted the sell-off, albeit perhaps temporarily given how we've opened up this morning. But I don't think it materially alters the outlook for gilt yields, and we still see them still traveling higher from here.
Okay, so they put a sense of calm into the market yesterday. We avert crisis yesterday. But Dan, I mean, are pensions still at risk? How do things stand now? What sort of conversations are you having with your clients to avoid this from simply just happening again?
Yeah, well, the Bank of England intervention has given a really important, taken the heat out of things and given a really important chance to take stock and make some of these transfers and move assets around in an orderly way, which is what was planned to happen. That's what happened earlier in the year when rates started to rise, collateral had to move, and that's all worked fine. When you've got a couple of weeks to make these sort of transfers of assets, that works fine. The issue is it puts a huge amount of operational strain when you're asked to move those assets in a couple of days or even in 1 day, which is what was happening because things were moving so fast. So a lot of work to be done by lots of folks over the next few days to take stock of the situation. But having that breathing space now to make those transfers in an orderly way, I think is really important.
What about the other side of things, Dan? So if you've had a reduction in hedges, again, due to these margin calls, what happens to them if yields start to fall? Are they exposed in that future?
That could be something that people are going to be thinking about, exactly, and that's all part of taking stock over the next few days of understanding exactly what the situation is for individual clients, where the hedges are, where they maybe need to replace hedges, where the hedges have been sustained or not. So that's exactly what people are going to be looking at. As I say, those hedges are there to protect schemes and try to stabilize those funding positions, and those funding positions have generally been pretty good this year. It's important to say rising rates have generally put DB pension schemes in a healthier position, and they're keen to protect that position. And to keep hedging and protecting that position. So that's what a lot of folks are going to be working hard to ensure keeps happening.
Okay. Andrew, let me bring this all to you. So pensions taking stock, perhaps some of the market drama put off for one day. But what would you advise Andrew Bailey and co., your former colleagues, what would you advise them to do from here in terms of their ability to keep hiking interest rates and to keep tightening? The market is pricing in about 150 basis points come November.
Yeah, that seems a very big move, given that the MPC have been reluctant to do anything more than a 0.5% rise so far. Many people thought they should have done at least 75 basis points at the last meeting. So they're playing catch up, and I guess that's what's reflected in some of those views. I would think that they should increase rates in November by 100 basis points, and
100, but Andrew, I mean, if I can jump in here, 100, we have all of these floating rate mortgages. I mean, wouldn't this cause mass pain to homeowners if they hike 100 basis points?
Well, there have to be consequences of a monetary policy tightening. And we have an independent monetary policy committee to take difficult decisions. I don't think anybody thought that inflation was going to go as high as it has. It's now roughly five times the Bank of England's inflation target. Some of that is to do with factors that will prove temporary, but not all of it is. And we've got a lot of wage pressure in the labour market. We've got other inflationary pressures which are domestically driven. And the bank still only has interest rates at 2.25%, which is historically a very low rate. So I think they do need to get rates up quite quickly to somewhere around about 4%. Maybe they can then take stock of the impact that that's having on the economy.
Andrew, I do just want to finish up with you because, you know, we do have Liz Truss speaking to the BBC right now, and it does sound like she's not going to back off. She's talking, you know, she's willing to do perhaps unconventional, controversial policy. She's saying that lower taxes will help grow the economy. Some folks have said that this is just an issue of messaging, and that's why the market has reacted in the way it has, Andrew. Is that fair? Is this just an issue of messaging?
I think it's more substantial than that. The plan that Kwasi Kwarteng set out went way beyond what Liz Truss said she was going to do in her campaign to become Prime Minister. And, you know, he threw in everything bar the kitchen sink in terms of tax reductions. And then the crucial thing is that he didn't say what the outlook for borrowing was and the outlook for the economy. And we're not going to hear about that until the end of November, which seems to me to be quite extraordinary, because normally those sort of forecasts come out alongside a budget. So I don't think that's just messaging. I think that's mishandling. And also the scale of the reduction in taxes is, I think this, according to the Institute of Fiscal Studies, the second biggest tax reduction we've seen in the post-war period, only being trumped by Tony Barber's reckless budget in 1972.
Imogen, is that fair that this is a bond market that's not reacting to just messaging? It's reacting to something more, a difficult fiscal position?
Yeah, I mean, going back to my earlier point, I think the bond market is reacting to this deluge of supply that's about to come on board. You know, this is pandemic-style easing on the fiscal front with the associated increase in supply to fund that easing. But on the other side of the coin, we don't have the same monetary policy easing that we had during the pandemic era to mop up all of that additional bond supply. So the government's going to be borrowing a lot more, borrowing that through the bond market, and that those bonds need to find a home. And it's not really obvious at the yield levels that we were at who was going to take down all that additional supply. So I don't think the move that we saw over the last couple of days was particularly divorced from fundamentals when we consider what was announced in the mini budget, what that implies for the growth and inflation outlook, and of course what that also implies for bank rate and how the market's pricing that to move over the next couple of weeks.
Then Imogen, what level of yields do we need to see to bring foreign investors back in, to bring investors back into this gilt market?
Well, we're thinking about a fair value for gilt yields right now. I think that it's actually closer to 5% than it is 4%. And I think that over the medium term is where gilt yields will settle, much closer to 5% than where we are currently. And at those kind of levels, I think you can start to see foreign demand come back and gilt yields, like I say, over a medium term in a less volatile market, settling pretty high. But I think that that's a fair reflection of how we see the economic outlook evolving, how we see bank rate changing over the next couple of months, and global factors as well, you know, how we see other central banks moving and sentiment more broadly within global fixed income. But 5% is the kind of next stop, I would say, that we're looking for in 10-year gilt yields.
Dan, your take, 5% 10-year, is that fair?
Well, we're not about taking views on the gilt market. I'll leave that to Imogen. We're just all about trying to hedge our clients' exposures and their deficits. So that's what we need to get back to and make sure that our clients
Okay, so
are
what would 5% mean to your clients then? What would the impact of 5% be?
Well, we've got to make sure those hedging programs are in a robust state where 5% doesn't pose any problem to them. That's definitely 5% is not far away from where we are. So I think that's the challenge, to make sure those hedges are robust to rates that are high and much higher than that as well, just to make sure these programs are really robust.
Okay, thank you all so much for joining us. Everything from pensions to gilts to the BOE itself. Really appreciate all of your insight. That's Imogen Bakra from NatWest, Dan Milkilskis from LCP, and Andrew Sentence from Cambridge Econometrics and former Bank of England MPC member, of course. Thank you all so much. Now, coming up, we're going to stick with the UK as the government seeks to rebuild its credibility and its mini budget causes an investor backlash. More on that next. This is Bloomberg.
Have been very popular. And if a client came to you and said, look, I'd like some cryptocurrencies in my portfolio, what would you say?
Oh, we've actually been really deep into crypto, deep into learning about blockchain, and all of the new businesses. You know, I would characterize us as crypto learners. You know, we have made a series of toehold investments on behalf of our clients, both in some of the currency baskets as well as with some venture firms that are investing primarily in the crypto area. I think it has the potential to be completely game-changing, but it is still such the Wild West, and it's so uncertain. But it has the potential to completely upend everything.
Somebody says, I want to be, and a person has an impact on society, what would you recommend that somebody do to work their way up?
Well, I think the first thing, you've got to believe in something.
that you really care about.
Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
Welcome back to The Open. Almost 50 minutes into your European trading day, we're looking at losses, the steepest of which do seem to be coming from FTSE 100 equities, down more than 2.2%. It is the home builders under immense pressure with expectations of higher rates coming from the BOE. Barrett Developments, that's down some 11%. Taylor Wimpey, that's down 5.5%. Rightmove down 5% as well. So we continue to see the fallout from a BOE that might be forced to really stamp down on inflation by hiking interest rates. We're also looking at gilts resuming their sell-off. It's the belly of the curve under pressure. 5-year, 10-year selling off. We're looking at about a 15 basis point rise from yesterday's level after we saw finally a rally in bonds. Now, Friday's mini budget and its fallout has rocked investor confidence in the new UK government. Prime Minister Liz Truss's 3-week-old administration now faces the challenge of rebuilding its credibility and calming jittery markets. For more on this, we are joined by Bloomberg's Philip Aldrich. So, I mean, Philip, we've got the Tory party, supposedly the party of sound money. Has it lost the trust of markets? Is credibility gone now?
It's certainly threatened the credibility of the Tory party. As you say, it's been the party of fiscal discipline. It's always marked itself out as distinct from Labour as the party that you can trust with the government's balance sheet. And really, what happened on the mini budget is markets suddenly were told, believe us, we're gonna, we will get the public debt under control. But they didn't set out a plan. So they said, take my word for it. And the market said, we don't trust you anymore. We're not going to listen. We're not going to take you on your word.
Yeah, to be fair, though, we knew that they would do some form of this. And markets had been already a little bit under pressure before the mini budget was announced.
Yeah, so it was the lack of, so they gave all the tax cuts and they announced a big number, but they didn't put anything on the other side of the ledger. They didn't say, we have to have some kind of fiscal discipline. We're going to have some spending restraint, or there's some efficiencies that are going to be found. They just focused on the tax cuts, and that basically turned out to be a big mistake. At the same time, the institutions have been under attack. So one of the good institutions in the UK is the Office for Budget Responsibility, which is basically the arbiter, the fiscal watchdog for the government. And they said, we don't need the fiscal watchdog to cost any of this. So there was a sort of conceitedness, there's a sort of arrogance in the Tory party, or in the government rather, to think they could push ahead with this and just assume the markets would trust them on fiscal credibility simply because of the historic track record. And it's been years in the making, and they've been losing credibility.
Yeah. And I just want to point out, we do have Liz Truss speaking on BBC Radio saying that there are difficult and stormy times in international markets. So again, speaking to local radio there, talking about that she still wants to push through with lower taxes, and that higher taxes lead to lower growth. Philip, thank you so much for joining us. Breaking it all down for us, Bloomberg's Philip Aldrich there. Now coming up, we're live with the CFO of Porsche after today's mega IPO in Frankfurt. Tom McKenzie will bring us that next. This is Bloomberg.
falling energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the Open. We're about 55 minutes into your European trading day. Stocks under pressure after yesterday's rally spurred by the BOE. UK stocks seem to be faring the worst. Home builders really taking a hit with expectations for some mega rate hikes from the BOE. Now, Total Energy CEO Patrick Pouyanné has told Bloomberg that cash flows from its Russia interests may come to an end in the coming months as tensions escalate over the war in Ukraine. Speaking exclusively to us, he says it's game over for Russia.
When you have a problem like what happened with Russia, it's more than a problem, it's a drama. You take the consequence. The consequence immediately for me were clear. We'll not invest anymore in any project in that country, even if we had quite a unique position in LNG in Russia. We built 10 years, 15 years, but game is over for me, you know, and just because I am responsible to allocate capital, and clearly it's not safe to invest in that country, so we turn our back to others. It happens to me that I spent 3 years of my life in Qatar 20 years ago, so I have a lot of personal relationships. We are working hard to have access to these new trends. Qatar has a giant project, 50 million tons. It's more or less the equivalent of 20% of the market they want to add as a supply. The market requires it. And so we made some good offers, and we are happy to be largest international partners. But you know, Qatar is a long history. We are the first to invest in LNG in Qatar 40 years ago. So it's, you know, in energy, long-term relationship and vision is just fundamental. Right. And I think it's part of the DNA of a company like Total Energies. So the consequence of that for me is clear. We have to be careful about geopolitical risks. Let's have a large portfolio. Let's spread our risks in order to be able to rebound.
Total Energy CEO Patrick Pouyanné there. Now, Porsche is also trading on the Frankfurt Stock Exchange. It's one of Europe's biggest debuts in a decade. Shares did open higher, even after parent company Volkswagen set a top price. Let's go out to Tom McKenzie, who's at the Frankfurt Stock Exchange with a guest. Tom.
Danny, thank you very much. I'm very pleased to say we are joined now by the CFO of Porsche, Mr. Lutz Meschke, who, it shouldn't be underestimated, is really very central, really key to the building out of this listing here in Frankfurt, this historic IPO for Porsche. So, sir, thank you very much for joining us. First of all, your reaction to the pricing, coming in a little above the top end. You priced it 82.50. The last time I checked, it was trading around 83. Your reaction to how the markets have digested this?
Yeah, 84. I would say it was a very promising start, and yeah, we are really pleased to have successfully placed Porsche AG on Stock Exchange Frankfurt. Despite the very challenging times, yeah, we have successfully mastered one of the biggest, largest IPOs in Europe ever, and yeah, therefore we are very proud. And yeah, I would like to say thank you to our entire team, whose work has ensured that we can stand here today.
And I cast my mind's eye back to 2018, 4 years ago. Yeah. And you came out and said maybe we should IPO Porsche with a market cap of around 80 billion euros. There was a bit of pushback internally, externally. when you came out with that. Do you feel vindicated?
Yeah, absolutely. It was a tough fight over 4 years now, but we succeeded. Now we can stand here. We are very happy, yeah, and we see further potential for the future with our strong brand.
How are you going to cooperate between the parent company, Volkswagen, and Porsche? You have a little bit more independence now, but we know historically there's been tension between the brands and the portfolio. How are you going to cooperate and make sure there are synergies that work for you at Porsche?
Yeah, we have negotiated an industrial cooperation contract with VW, and there's clearly regulated that Porsche has 100% autonomy in future. The Porsche board will decide in future, completely independent from VW. And yeah, that's a great situation for us. We want to unlock Porsche's full potential, of course, but we have also the possibility in future to work together with the VW group brands where beneficial for Porsche. That's the case when it comes to sharing technologies like the Taycan used also for the Audi e-tron GT, pooling emissions, bundling purchasing volumes, or also using production capacities like the Cayenne in Bratislava.
Okay, and talking about production, so you have the factories in Germany, you're producing in Slovakia. Where do you build out the factories of the future for Porsche?
Yeah, hopefully in Germany and in Slovakia. There's no other plan. And of course, we established a CKD production in Malaysia due to the tax situation and customs situation. But nevertheless, focus is on Germany, is on Europe when it comes to production.
The US and China. It doesn't make sense to build out factories in the US or China.
Yeah, it's important to have a good footprint in China and the US. Therefore, we decided to develop our software completely in China itself and in the US. And it's absolutely necessary in order to meet the needs and requirements of the local customers there. But when it comes to hardware, we want to stay in Europe.
Okay. How much of the 9.4 billion euros that's been raised as a result of this IPO is going to go towards Porsche and your electrification plans? And what is the time frame for electrifying the SUVs, the Macan and the Cayenne, that have proved so popular?
Yeah, it's important to say that we have a very strong net cash flow. Therefore, there's no further financial resource necessary when it comes to Porsche. VW will use the additional resources to accelerate their transformation and to make investments in future when it comes to battery cells and software architecture.
Okay, and what about the timeframes for electrifying SUVs?
Yeah, the e-Macan will be launched in 2024, followed then by the E718.
Will you electrify the 911?
You never know.
You never know.
But of course, yeah, it's the core, it's the heart, it's the soul of our company, the 911. And therefore, we want to drive the 911 as long as possible with a combustion engine, of course.
Okay.
But you never know what will happen regarding the legislation, and therefore you have to be very flexible.
It sounds like you'd be reluctant to see a fully electric 911.
Absolutely, we can live very well with the 911 with combustion engine. It's very successful.
A lot of focus in terms of the macroeconomics on currency volatility, and you're consequential in building out hedging within VW, FX hedging. So talk to us about how you're managing to mitigate the FX effect. To what extent it's a headwind? To what extent it's a tailwind for a business like yours?
Since we don't have natural hedge in place, since we have the production plants in Europe and the major part of our sales are in non-euro currencies, yeah, we are more or less obliged to have a flexible hedging strategy in place. We work a lot with option derivatives, and the hedging period is 3 to 5 years, and therefore we are quite confident that we can see also tailwind in future from FX for the upcoming years. Yeah, we benefited from about 200 basis points FX effect in 2022, and we expect to have a similar situation in the upcoming years.
Okay, and you've set yourselves a revenue target that some would argue is pretty ambitious given the recessionary concerns, 39 billion euros of revenue for this year. Can you meet that target? Are you seeing a drop-off in demand?
Absolutely. We were always very strong when it comes to crisis situation, and also in the first half 2022, we had a lot of overlapping crises. Ukraine war, the semiconductor shortage, wire harnesses shortage. And we were able to further increase our net profitability margin and also our net cash flow. That means Porsche is a very resilient company, and therefore we are quite confident to meet our forecast figures.
Quite confident to meet that 39 billion euros. Talk to us about how you're mitigating the energy impact as well. So much concern about the reduction of gas, particularly to Germany, in a very cold winter.
Yeah.
What steps are you putting in place? What mitigation are you putting in place around your factories and production facilities?
We are not dependent on Russian gas with our production plant, but nevertheless we are affected by the entire economy. Therefore, it's important to find measures to reduce consumption, and we did it, as we did it also in our entire economy in Germany, and we are able to reduce consumption by about 20%. And when it comes to energy supply, we think due to the situation that the gas storage tanks are filled about 90%, we are in a much better situation than expected 2 or 3 months ago.
And what are you seeing in terms of those supply chains then, and the ability to get hold of the semiconductors and the chips that you need? Are the supply chain issues starting to be resolved?
Yeah, it's not 100% level, of course, but we are on a very good path. And when it comes to the future business, then it's very important not just to rely on the tier 1 suppliers, but also to dive deeper in the entire supply chain. And therefore, we are also in good contacts, for instance, with the wafer producers. It's very important to have close contact when it comes to the entire value chain.
Okay. Lutz Meschke, thank you very much indeed. CFO of Porsche, who pitched this idea, Danny, back in 2018, faced some pushback, but as you say, he feels vindicated now. Danny.
Thank you.
And certainly we're all excited by finally having another big IPO in this market after a dearth. Tom, thank you so much. Fantastic interview. Bloomberg's Tom McKenzie there. Now we are looking at the sell-off in gilts back on again after the BOE stepped in yesterday to buy long-term bonds. We did see the long end fall by over 100 basis points, but we are looking at declines. It does appear to be in the belly of the curve where we're seeing most of those declines. 10-year yields, those are up by about 17 basis points. All of that action happening after Liz Truss speaking to local radio, the Prime Minister saying it is not the time to reverse course on eco plans, also talking about the idea of higher taxes, that would lead to a recession. So Liz Truss not ready to change course. Now, across assets, we are continuing, again, the trend of risk off, well, everything off, everything except dollar continuing. Bloomberg dollar spot, that's up 0.6%. The pound, that is lower by 1%. Cable at the moment is trading at 107.79. 10-year yields, again, as a factor, as the sort of seep through from the UK bond market. We're also looking at yields up 10 basis points as well. At one point, though, yesterday, yields were touching 4%, so we still have come down from that. And of course, European equities, those are lower, being led by UK equities. A lot of the home builders in the UK under pressure with expectations for a Bank of England hike. Now, speaking of which, the British government says it will push ahead with its budget plans despite the Bank of England staging a dramatic intervention to stave off an imminent crash in the gilt market. This, of course, all happening after Prime Minister Liz Truss's tax cuts plan. All of those announcements from Kwasi Kwarteng just ripping through UK assets. First, let's get out to Bloomberg's Lizzie Burden, who's outside the Bank of England. I mean, Lizzie, the remarkable steps from the BOE. Where do they go from here?
Well, Danny, the important distinction to make is that this was a financial policy decision to stave off the instability in the gilts market. So they've restarted quantitative easing. But at the same time, the chief economist Hugh Pill said earlier in the week that we can expect a significant move on the monetary policy front at the next meeting in November. That, of course, to curb inflation, and of course there's huge pressure to save the pound. So the expectation is that at the next meeting, our economists expect anyway, there'd be a 100 basis point hike from the Bank of England. Markets are still pricing for an intra-meeting move. But at the moment, it looks like the Bank of England's confused and dancing to the tune of fiscal policy.
Yeah, I mean, to be fair, sort of in this debate of who blinks first, the BOE or Liz Truss and Kwasi Kwarteng. I mean, Lizzie, I'm looking at this interview from Liz Truss on the BBC, basically saying it's not the time to reverse course.
No, and I would also note that Liz Truss is only speaking to local radio, the audience of which is predominantly older people, so she's preaching to the choir and she's avoiding the difficult economic and financial questioning. She, as you say, is digging in. She doesn't look like she's going to U-turn. She says that her tax cuts are going to grow the economy. Other junior ministers have said that every major economy is facing this sort of blowback. Well, the International Monetary Fund has name-checked the UK specifically, so that's not going to wash. There's also pressure for her to sack Kwasi Kwarteng, but of course they're close personal friends. They're very aligned politically, so that would be a huge humiliation for her. What's more likely to try and restore credibility, and you've had the former Bank of England Governor Mark Carney saying that the government's undermining the UK's economic institutions, is that she tightens the spending. But that, of course, is going to be politically unpalatable in a cost of living crisis when she said she wouldn't return to austerity in the leadership campaign.
Okay, Lizzie, thank you very much. Bloomberg's Lizzie Burden there on Threadneedle Street. Well, let's dive into the market reaction, the market conversation with Maya Bandari, Global Head of Multi-Asset at BNP Paribas, and Bloomberg's Justina Lee. Justina, set the scene for us. I mean, this backdrop of you get stocks falling to their lowest of the year, and then the best rally since 2020, they're falling again. I mean, what do you make of the past 24 hours? How did we get here?
Yeah, it's really been like a crazy day because we did have a bit of a relief rally yesterday on the back of the BOE action. You know, stocks kind of bounced back, you know, bond yields were going down again. But I think today's price action is a clear sign that, you know, whatever that BOE action meant, it was not going to kind of solve markets' more long-standing worries about inflation in the UK, about the long-term fiscal burden. And indeed, today we're seeing S&P futures down again, bond yields up again, and the pound falling as well. And so it's a clear sign that those worries are still front and center in investors' minds.
So, Maya, I mean, perhaps the trajectory of where we're heading doesn't change. The pressures are still there. But has something changed for you in how you approach these markets after seeing the BOE step in yesterday?
Well, I mean, I think what the BOE did yesterday was big, as we were discussing just a moment ago. You know, I mean, we flipped from quantitative tightening to quantitative easing. But I mean, I guess thinking about what that means for UK assets more broadly, frankly, I think it's very difficult to put a correct risk premium on UK assets, and for a few reasons for that. I mean, first, as you just reflected, we've got a large fiscal package that for now seems very much in place. It's an unfunded package and the largest in 50 years. At a time when the Bank of England is hiking rates to cool inflation that's hotter and stickier than elsewhere, but now also buying long-dated bonds, potentially to resolve a large issue for LDIs and pension funds, you know, and that's before we get to things like Brexit and Article 16. And so I think it's for me, and I think from a BNP PAM sort of multi-asset portfolio perspective, it's very difficult to say, you know, is this good value? Is it not? Because we're finding putting the right risk premium extremely challenging.
And probably when you think you have it, you just get extreme whiplash in these markets as well. We're actually just going to pause on this conversation for just one moment. Justina Lee and Maya Bandari of BNP Paribas are going to stick around with us. But first, we're going to go out to Frankfurt quickly. Tom McKenzie is there with Porsche's CEO. Tom.
Keep it going. Keep it going. Danny, hello. Thank you very much indeed. Very pleased to say we are joined by the group CEO, of course, of Volkswagen and Porsche, Mr. Oliver Bloom. Thank you for your time, sir. Your reaction to the pricing that we've seen in the market then, just above the top end, 82.50. We're above that as things stand.
Today is a historic day for Porsche. Porsche AG is back on stock market, and an emotional day, and for me it's a big honor to be here. For all our team has done a fantastic job, and the first reaction of the market is very, very positive, and that shows the potential of our company.
Why did it make sense to list now, given market volatility we're seeing globally?
We have shown during the last years a very strong...
How do you address the governance concerns? You're the CEO of Volkswagen, you're the CEO of Porsche. What is your message to investors who are concerned about governance?
Yeah, it was well planned, and after the IPO now, Porsche is a autonomy company, And so we are separating both businesses very clearly, and we won't have conflicts in between. And so it will work.
Given the success of today's IPO, can we look at Lamborghini potentially as another unit that will be spun out of the Volkswagen Group?
I see Porsche as a role model. We have shown what is possible if the company is well prepared. I think that will be also a win-win situation for Volkswagen Group. And for the future, we will see. I think there's a lot of potential in Porsche, but also for Volkswagen Group.
Okay. One last question on demand that you're seeing. And within these concerns about a recessionary environment, are you seeing a slowdown in demand?
Yeah, we don't expect a slowdown for Porsche in demand because of the recession effect, because we are well positioned. We have a product portfolio for the next years, which is very, very stunning and emotional for our customers. And so we are looking very positive to the future.
Mr. Bloomer, thank you very much indeed on a busy day. Danny, we're going to throw it back to you. Mr. Bloomer is a busy man and much in demand. Danny.
Tom, thank you so much. Tom McKenzie there with Porsche's CEO. Busy in Frankfurt, busy here in the UK, in the London studio as well. Still with us is Maya Bhandari, Global Head of Multi-Asset at BNP Paribas, and of course, Bloomberg's Justina Lee. So Maya, you know, before we went out to Tom, we were talking about this idea that it's just so difficult to find fair value in this market now. So how does it end then? Where does this go to a point where we finally say, okay, the pain in this UK market, it's reached its end point?
So I think we have a few options on the table, right? I think the first option would be a recasting of the fiscal plans, which I guess based on this morning's news perhaps seems a little bit less likely, though we do have till the 23rd of November for that to come through. The second, I suppose, is more intense rate hikes from the Bank of England. The third is nothing. I guess the first of those three options is perhaps from a market perspective the best outcome, and the last is the worst. And so I think, you know, there's so many, there's at least three possible scenarios with very different asset market implications. And I think for the next couple of weeks we've just got to wait and see.
Yeah, and all of it is just continues to contribute to volatility. I mean, Justina, we started out this conversation talking about it. I mean, what happens to strategies that are volatility targeting, or just anyone who has a certain appetite for risk, and that's completely blown out the window, seeing, you know, 30-year yields on government bonds move 100 basis points in one day?
Right, exactly. I mean, it does feel like these days there's nowhere to hide. I mean, we even had like a bit of a retreat in commodities in recent weeks. And so, you know, when times like these and bonds and stocks are both falling, I mean, you know this, we always talk about risk parity.
Always.
Exactly. And indeed, we are seeing a huge plunge in risk parity strategy these days. And what markets are always concerned about is that you kind of get a chain reaction, right? Because with volatility going up, a lot of these leverage players need to deleverage in their strategies, and they end up selling more bonds and stocks.
Justina, you knew I'd bring it back to the quants. I think you joined us knowing we'd go there. Maya, I mean, to that point, where do you hide out right now?
Well, I mean, one of the places that we had, we've managed very actively and had a fairly significant position was in short bonds, which we actually closed yesterday. So we sort of built those positions in March when yields were at 175, and as we got to 4 on the US, we stepped away. But where are we finding opportunities? So today we are long of commodities, something that didn't help us yesterday, but has been something that's been of an important diversification for portfolios. But an area actually where we've been turning increasingly constructive over the summer and more recently is European investment-grade credit, actually. Now, that's an area that is priced for default. I mean, you know, these are the highest-rated European corporate bonds that are priced for, you know, 9.5%, 10% defaults over the next 5 years. Something we think is very unlikely, and so that's, if you will, a bit of a valuation opportunity in this carnage that we are taking some advantage of.
What do you do with this equity market? I mean, much has been made of this idea that perhaps we haven't fully reflected the earnings recession that we're going to see going forward, but we are looking at, you know, equities near lows for the year. At what point do you jump in and buy?
Well, we haven't reflected any recession in earnings expectations yet, frankly, because if you look at the returns we've had this year, for example, they would have been considerably worse were it not for actually expectations for positive earnings growth this year and next year. And so, indeed, the reaction we've had in markets this year reflects entirely the move we've seen in bonds and nothing really, or not much by way of cash flow. So we are BNP Paribas very much neutral on equities here, but with a cautious tilt, and that caution is very much in Europe, ex-UK, where we see the downside risk, if you will, to earnings as being most profound. I mean, it's kind of striking that when you look at bottom-up analyst expectations across most sectors in Europe, you've actually seen better earnings expectations despite the darkening economic clouds, and so we think equity markets are still potentially vulnerable in Europe. Against that, markets in Asia do look interesting. So the neutrality is, if you will, cautious in Europe, married with more optimism in Japan and China, both of which are on a different path in our review and have better earnings, better policy setups.
And so the fundamentals are there, Maya, but I do wonder if you continue to worry about VAR shocks, about stresses that are not following the fundamentals, where things get out of whack, where liquidity is low, and you have these possibilities. What do you do presented with this problem, that you continue to see more days like yesterday, like this week going forward?
I mean, it's very hard. There's no question about it. I mean, I think the way we have managed, frankly, for much of this year, really starting from April onwards, is take a rather cautious view on how much risk we're consuming. Back to your point on how risk parity more broadly, and funds that invest with a set level of risk have suffered. We've been consuming around a third of our overall risk budget, so very much at the cautious end, reflecting precisely that the market environment is challenging and extremely volatile across the beast.
Unfortunately, I feel like that is the perfect note to leave things on. Maya, thank you so much. It's Maya Bhandari there, BNP Global Head of Multi-Asset, and of course, Justina Lee from our markets team. Thank you both so much. Now, coming up on the program, we're going to be speaking to the Volkswagen CFO later in the show. Don't miss that, with one of the first big European IPOs to hit the market. This is Bloomberg.
of a push have you seen from the Kishida government in terms of green funding? The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space. What do you make of Kishida's new capitalism? Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
I think it was the right thing to do, given the technical factors that had arisen in the market, and it's obviously brought some important stability to the gilt market. It does not resolve any of the fundamental contradictions in British policy.
Former U.S. Treasury Secretary Larry Summers there weighing in after the BOE's intervention. Let's now get to some of our top stories with the Bloomberg First Word News is Leanne Gerrans. Good morning, Leanne.
Hi, Danny. The European Union has proposed a new package of sanctions on Moscow that would ban European companies from shipping Russian oil to third countries above an internationally set price cap. Commission President Ursula von der Leyen says the EU is determined to make the Kremlin pay for the further escalation of the war. The CEO of Ukraine's state-owned energy company has told Bloomberg TV the risks of an attack on the country's gas transit network have increased dramatically.
The reason why we're continuing transit is not because we want to continue getting revenues from transit, but it's because our European partners are saying that, at least for the time being, they need this gas and they depend on it, and they want Russia to prove that they're not a reliable supplier, not Ukraine to stop the transit. That's why we're continuing transit. And we are going to continue transit at least when it's still technically possible. And despite the war, despite the hostilities, we prove to everybody that we are a reliable transit country.
Now, Hurricane Ian has hit southwest Florida with a massive and deadly surge of water and catastrophic winds. More than 2 million people have been ordered to flee in what could be one of the costliest storms in U.S. history. Nearly all of Florida, home to 21 million people, is braced for widespread blackouts and floods. Pakistan's foreign minister says his country will need to revisit an IMF package signed last month because of the financial toll from recent floods. Bilal Bhutto Zahari renewed his call for debt relief, saying the damage is expected to exceed $30 billion. He also warned of looming food crisis due to the flooding and the war in Ukraine. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thank you very much. Now, coming up, we're going to be speaking to the Volkswagen CFO, Arnaud Anslitz, as Porsche begins trading on the Frankfurt Stock Exchange, getting a little bit of that IPO pop amid an otherwise ugly trading day. This is Bloomberg.
Cryptocurrencies have been very popular. And if a client came to you and said, look, I'd like some cryptocurrencies in my portfolio, what would you say?
Oh, we've actually been really deep into crypto, deep into learning about blockchain, and all of the new businesses. You know, I would characterize this as crypto learners. You know, we have made a series of toehold investments on behalf of our clients, both in some of the currency baskets as well as with some venture firms that are investing primarily in the crypto area. I think it has the potential to be completely game-changing, but it is still such the Wild West, and it's so uncertain. But it has the potential to completely upend everything.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
Welcome to Bloomberg The Lineup.
The BOE bounce fades. Global stock rally from bonds ignited by the Bank of England. That starts to fizzle as European equities and treasuries decline. The credibility question, the UK government steps up its efforts to build confidence after its disastrous mini-budget. But there's no U-turn in sight. The pound rebound snaps. Plus, turbocharged Porsche starts trading higher as part of the biggest European IPO in a decade. Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. So Porsche started its first day of trading on the Frankfurt Stock Exchange in one of Europe's biggest debuts in a decade. Shares now higher by nearly 2%, even after parent company Volkswagen set a top price. Let's go out to Frankfurt, where Tom McKenzie is at the stock exchange, joined by someone who will be watching that IPO price action very closely. Tom.
Yeah, like a hawk, and they're buoyant, the view here and the mood amongst the executives of VW and Porsche. Very pleased to say, Danny, that I'm joined by the CFO, Arno Antlitz, of Volkswagen Group. Congratulations on the IPO today. A key question for many people outside of Frankfurt today will be why? Why choose this moment amid all that market volatility to list this business?
Look, first and foremost, I must say we're very happy to stand here today. We've taken Porsche successfully public. And I must also say, we were always positive, we were always optimistic. Porsche is a brand of its own. It's a fantastic brand. It has a long track record of delivering. It has very solid financials. We have a very, very positive and exciting future, a clear strategy, a great management team. So we were quite optimistic and quite sure that we can prove successful today, and success proved us right.
And that success has led to a market valuation for Porsche of about 75 billion euros. The market valuation for Volkswagen Group is about 85 billion or thereabouts. The gap isn't huge. So how do you convince investors to invest in Volkswagen versus Porsche? How do you create that additional value for Volkswagen?
Look, also on a Volkswagen Group level, we have a very convincing strategy towards electrification and digitalization. We have a challenging plan to achieve 25% of our sales of better electric cars in 2025 and 50% in 2030. We invest in our own battery capacity, in our battery technology. We want to build, in Europe alone, 6 battery plants to make sure that we have a secure and efficient supply of batteries. We have a convincing strategy in terms of software. And we are quite optimistic once we get proof point by proof point that we can also convince the market that it's also a good idea to invest in Volkswagen AG.
Okay, and you've raised 9.4 billion euros. Part of that will go towards the dividend, the special dividend, and a big chunk, of course, going towards electrification and software, as you've said. Can you give us a little bit more granular detail as to exactly where you're going to be directing those funds across the portfolio of VW brands?
No, this is right. We want to reserve these funds really for investing into our future of electrification and digitalization. As said, we want to specifically reserve that fund for investing in our battery capacity in Europe, but potentially also in the US. We built up 6 factories there, but we also invest along the value chain upstream in raw materials, in cathode production, and this is one of the fields we want to invest at. We will invest it also in software, and another field is also charging infrastructure. You're aware we are building up right now one of the biggest charging networks in the US, and we invest also in charging infrastructure in Europe. So these are examples for the fields these funds are basically reserved for.
You talk about capacity. Your biggest factory is running at about, 50% capacity. When do you get back to kind of pre-pandemic levels, almost full capacity for factories like that one? What are you starting to see?
Look, we have to look at that from 2 angles. First is supply, and currently we are still limited by the supply of semiconductors. Now, we see a better situation in the fourth quarter and also next year, but from today's perspective, until at least end of next year, there will be a limited supply of semiconductors. On the other hand, we increased our fixed cost, we decreased our fixed cost, we decreased our capacity, and that made us much more robust. We compared the fixed cost versus 2019 we reduced the fixed cost versus 2019 by 4 billion euros. And basically, these 2 effects together will make us much more robust. And we showed the robustness already in the past.
What other steps are you taking to improve cash generation for the business?
First and foremost, I said it's on the fixed cost side, but also on the revenue side. We increased margins. We increased revenues per car. Customers are ordering better equipped cars from higher segments. So these are 2 potential effects we work on.
What about euro-denominated bonds? You're one of the biggest issuers of euro-denominated bonds. Are you comfortable to continue issuing in this market environment?
Refinancing is one of our competitive advantages, one of our strengths. So this is also a pillar.
So you'll continue to tap the markets. You'll continue to issue.
We will have to decide on that.
Okay. You talked about batteries. You have PowerCo, which is a big part of that push and that effort to build out battery infrastructure. Can you update us on the IPO plans for that part of the business?
Yeah, as you said, or as I said before, there's a huge investment in that field to do. 20 billion plus in the factories, another 10 billion. And we don't want to have do all these investments by ourselves. We will look for strategic partners potentially from next year onwards, and potentially also in the future we don't rule out even an IPO on the battery side.
Possibly an IPO of PowerCo next year?
IPO of PowerCo next year would be much too early. Okay. Next year we will start looking for strategic investors. IPO rather later on, but the funds or the proceeds we just received from the Porsche IPO will give us much more flexibility to finance it by ourselves a little bit longer and then potentially IPO it a little bit later.
Okay. What is the resilience of the business facing the headwinds that is the energy crisis here in Germany and across Europe?
As discussed, we showed a lot of resilience in the past. Specifically, for example, in last half year, there were a lot of challenges by COVID in China, semiconductor shortage of wiring harness, and despite that, we proved rather resilient and delivered decent results.
No, do you expect to see any shutdowns at all this winter?
We basically look closely into that topic as well. We have a program to reduce, for example, our gas demand. Factory by factory, we will reduce the temperature in the plants, in the offices, and so there are a lot of measures in place. So we don't expect for Volkswagen any shortages from today's perspective.
Arno Antlitz, thank you very much indeed. The CFO of the Volkswagen Group there, giving his views on what to look ahead for as well as this company enjoys the success of this IPO, maybe looks to spin out the battery part of his business. And we were speaking to the CEO earlier about potentially Lamborghini as well. He didn't push back on the idea of the CEO that could be also a unit that they spin out. Back to you, Danny.
All right, Tom, thank you so much. Fantastic conversation. Bloomberg's Tom McKenzie there in Frankfurt. I'm sure a very happy man the CFO is, considering Porsche now up 2.6% in its debut. All right, let's get to the Bloomberg Business Flash. With that is Leanne Gerrans. Hi, Leanne.
Danny. H&M says it will cut costs by $180 million a year after earnings slumped at the lowest cost clothes retailer. Adjusted operating profit in the latest quarter came in well below estimates on higher garment and transport costs and following the Swedish company's exit from Russia. Now, Amazon has announced a pay rise for hourly staff over in the US. It says the average starting wage for most frontline workers in warehousing and transportation will increase to more than $19 an hour, a move costing about $1 billion a year. Earlier, Bloomberg reported that Amazon is encouraging some US call center staff to work from home in order to cut costs. Turkish President Recep Tayyip Erdogan has called for interest rates to be cut to single digits by the end of the year. Rates have already been lowered to 12%, but Erdogan told CNN Turk TV to expect even further cuts. The Turkish leader has long insisted that higher rates bring down inflation, which is currently above 80% in Turkey. And Total Energies may sell part of its 20% stake in Adani Green Energy. That stake was worth about $10 billion at the end of August. CEO Patrick Pouyanné says its holding in the company is a source of potential cash and its balance sheet is indeed safe. And that's your Bloomberg Business Flash. Danny.
Leanne, thank you so much. Now, coming up, what happens to UK deal making when we look at a weaker pound? Are there more buying opportunities? What about the entirety of Europe? What does the deal picture look like? We're going to be speaking to Adarsh Sharma from Warburg Pincus after the break. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg Surveillance. It's the early edition. I'm Danny Berger in London. Well, let's focus in on private equity. And the industry is, of course, under pressure, as every financial industry is in this current climate. We have banks looking at struggling funding and, of course, borrowing costs on the rise. But where are the opportunities? Is it perhaps in the UK with a weakening pound? Well, I'm pleased to say we are joined by Warburg Pincus co-head of Europe. It is Adarsh Sharma. Thank you so much for joining us today. So, I mean, look, it has been a very wild week, especially here in the UK. You get financial markets, a rupture there, concerns about fiscal policy. Has anything changed for you for investing in the UK?
Nice to see you, Danny. It's interesting that we talked last time. It was a different crisis in 2021. At the beginning, we were both sitting in lockdown. And I think in 2023, if we're talking at the end of the 2023, we'll be talking about a different crisis. Short term, I think there will be a lot of uncertainty. There will be a lot of noise. You know, we are long-term investors, so we focus on the long term. We focus on building and scaling companies for the long term. We obviously take in what is happening in the short term into our mindsets as we plan for that, but it's really long term. And you know, Warburg Pincus has built and scaled about 1,000 companies since our founding in 1966. And we're always looking for entrepreneurial management teams that we can actually back, even in these uncertain times, to create sort of the next category leaders. I'll give you a little bit of perspective on how we do that. You know, one, we sort of think about the micro, not the macro. So we're looking to back sort of high-quality companies in that environment, long secular trends. Even if the trend lines are a little bit deflated for the moment, the trend lines will come back. Second, partnering with best-in-class management teams. I think leadership in these tumultuous times is very important. And third, we adopt a mindset, at least in Europe, of paranoid optimism.
I love that phrase. I do want to get into that, but just quickly, if I can just linger on the UK question for one moment. I mean, if you are focused on the long term, and these are perhaps short-term fissures, do you say equities look cheaper? Perhaps there's opportunities to jump in, to buy, especially with a weaker pound?
Yeah, you know, we're not buying public companies in sort of small pieces. The take private of public companies, whether it's the US or Europe and the UK, those opportunities actually do look interesting. And where private capital can step in because public capital is not available to these companies for growth, we're absolutely looking at those opportunities.
So paranoid optimism, what does it mean?
Two parts to it. You know, one, paranoia, we sort of think about the risks. We think about what the solutions and mitigations are. And if the solution mitigations actually don't deliver a sort of an answer to us, if it's a bump in the road, great. If it's a chasm, we wait. So that's sort of really how we think about paranoid optimism. And the one thing I'd just say is, you know, human ingenuity, you can't sort of underestimate it. It's helped us get through past crises, and it will again this time.
We are in this period now where interest rates across the world are on the raise. The era of cheap money is over. To what degree does this change the industry of private equity, where many folks, to use perhaps not the kindest of words, we're doing financial engineering? Is that model now over and done with in the industry?
I think the industry's changed a lot. If you looked at private equity over the years, the industry has become much more about value creation in its companies. And for us, you know, more than a third of our companies don't have debt. If you looked at our sort of 200 plus companies, we'd say we're under 3 times levered in our portfolio, which sort of says that, you know, growth investing is a skill set that's different from financial engineering. It will have an impact, but the other impact is, I think valuations will start coming down.
Have they started to come down yet? What does it look like at the moment?
No, I mean, you know, A companies still get the same top valuation. We're looking at it, and sellers don't have any urgency to sell if they don't get the A valuations. We sold a couple of companies this summer after a 5-7 year hold, and we got the same prices we had expected a couple of years ago.
That's really interesting, this idea that people don't perhaps want to sell at this moment, because then you have to crystallize some pretty significant losses. So what does the deal market look like then?
The deal market has slowed. And so what's happened is a lot of new types of capital have also come in. Sovereign wealth funds, large family offices, the limited partners that invest in us have also become GPs. They've become sort of direct partners with us, which is actually a really nice evolution in the industry. We like showing co-investment opportunities to our limited partners. We partner with them to buy things. What that means is some of our companies, we do a minority sale. So, you know, we want to hold it, but we do need to return capital to our investors. So we'll do a small minority sale. We'll hold it for a little bit longer period of time, and then do a majority trade when the timing is right. So there's a lot of different ways in which we can manage our companies, no different than public markets. It's just that the public market environment has become much more of a private capital mindset.
Are you doing the flip side, or are you taking more minority stakes as well then?
Yes, we are. So, you know, we have had flexible capital since the beginning when we started in 1966. About half our investments are majority, the other half are minority.
Okay, so then you're looking in sort of the exit environment. There's also been not many IPOs, I mean, which is maybe even kind to say as well. But we did see Porsche's IPO today. We saw shares rise 2%. Do you look at something like that and say, okay, perhaps the IPO market is on its way to get back on track? What are your expectations?
I think the IPO market is going to come back, but it's going to be a while. I think until the noise in the market sort of goes away, I don't think people are willing to come to the IPO markets unless they have a real liquidity crunch, because if the shares start trading underwater from day one, that's a bad place to be. Now Porsche is a very large company. It's a great brand. It's well recognized. And we're delighted that Porsche IPO is off to a good start, and we hope it stays there. But in general, I think the IPO markets will be slow for a bit of time. And for private equity, actually that presents an opportunity because these companies still will need capital. And we can step in and provide the capital in a flexible mindset and have growth orientation towards it, all of which will work well for us.
So, I mean, it definitely is a complicated environment to invest in, is what I'm getting from you. But there are opportunities. I do wonder, though, if when we look back at perhaps the last era of private equity, if you will, before interest rates started rising, before we saw ruptures in this market, was there a degree of private equity just being too easy?
If I could tell you that every day I went to work and worked with my companies and tried different things and it was easy, that'd be great.
Did not mean to say that your job was easy, to be clear.
No, I know. I'm just joking. I think the value creation part of what we do is actually differentiating the private equity industry. So the private equity industry has matured. It's become very large. I think there have been some that have sort of gotten away with a little bit of easy capital. But I think most generally, private equity is really focused on, really creating value, being decisive with its companies, finding the best management teams, and not being short-term in orientation. And I think that's going to continue. As an industry, the industry is still a tiny fraction, a couple of percentage points of the overall liquid and illiquid assets. So I think there is real opportunity for that.
Of course, when I think of Warburg Pincus, I do think of tech. I mean, obviously, you're giants in this space, sort of distinguishing between the tech, because you look at consumer tech, maybe the Apples of the world under pressure, chips, it's a whole other hotbed. Where do you focus in on to say, okay, going forward in tech, this is where the opportunity set lays?
There are a couple of areas we're focused on. One is, if you sort of think about what happened in COVID, education has had a void, and the K-12 and even higher education. So we are focused on education services, education tech, supply chain software, compliance, visibility. It used to be, in business school you learned, I just need just in time, and I need one supplier who's going to do it, and that one supplier ends up from China. Today, that doesn't work. You need a mix of local and international suppliers, so supply chain software. Digitalization is becoming much more of an important focus for companies. AI enablement, not the selling of AI, but AI enablement to do things like know your customer, anti-money laundering, fraud, all of that stuff is becoming important. And lastly, data management. I think there's so much data out there, but how is that data actually going to help you make better decisions in what you do? We've invested in a company recently called Informa Pharma. We actually carved it out from Informa PLC. And it provides intelligent data to the ecosystem of pharma and biotech to help get medicines and drugs quickly into the patient's hand. That's the kind of stuff that we're looking at investing in this environment.
Okay, Adarsh, I'm afraid we're out of time, but thanks so much for joining us. Thank you for sharing a slice of your paranoid optimism with us. That's Adarsh Sharma, co-head of the European business at Warburg Pincus. Now, coming up, we're going to circle back to the UK story with the government seeking to rebuild credibility as its mini budget causes investor backlash. More on that next. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Somebody says, I want to be a person has an impact on society, what would you recommend that somebody do to work their way up?
Well, I think the first thing, you've got to believe in something that you really care about.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. Let's get back to our markets conversation. Joining us now is Irene Garcia Perez from our markets team. So, look, the trend resumes, right? Bonds sell off, pound is weaker, dollar is stronger. Yesterday, having the BOE step in, did anything change for this market?
Shortly. It was definitely short-lived. This morning is like investors digested the news. Everyone knows the BOE action is going to last for a month or so. Had to step in to basically bail out UK pension funds. But this is going to end, and it's going to end soon, and the economic policy in the UK is going to remain, and it looks bad for inflation.
So what? So what, we just get the bond vigilantes coming back in, just testing the BOE again?
It looks like it, and again, the expectation is the BOE raising rates. This is going to, well, tame inflation, but at the same time hurt in other aspects like mortgages. We were seeing the yield on the 2-year interest rate swaps, for instance, which is used to price mortgages, at the highest since 2008. Which, you know, is going to hurt for UK consumers.
Yeah, especially if the BOE is going to hike 150 basis points. That's what the market is pricing, and you'd assume that that would be really, really painful. So definitely have heard some questions about whether or not they can actually go through with that. Irene, I'm afraid we're out of time. Thanks so much for joining us. Irene Garcia Perez there, helping us wrap up the market conversation for the hour. Now, Bloomberg Surveillance Early Edition, it continues in the next hour. Matt Miller and Kaylee Lyons are out of New York. Anna Edwards in London. As equities resume their slide after the BOE stepped in yesterday, you're looking at yields pushing higher throughout the UK, throughout global bond markets as well. This is Bloomberg.
going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
Investors are becoming increasingly concerned about, not just the U.S. economic outlook, but the global outlook.
The dollar and is really the dominant story behind a lot of what's going on here.
Some stabilization for the markets would be a good thing.
Governments, central banks are going to try all kinds of things we've not seen for a long, long time.
We're seeing chaos in the markets. We're seeing, the economics of pandemonium.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. British Prime Minister Liz Truss stands by the tax cuts, saying urgent action was needed to get the economy going. Now the question is whether her government can restore credibility with investors. Porsche goes public. Shares of the sports car maker begin trading after Europe's biggest IPO in a decade. And Hurricane Ian weakens after pummeling Florida with catastrophic winds and a deadly storm surge. It's one of the costliest storms in U.S. history. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Well, help from the Bank of England in terms of global risk sentiment didn't last too long, did it, Kaylee? We're back to those losing ways.
Yeah, it didn't last long at all. It only lasted about a day, and you're already seeing, again, equities down and yields up. So it was a very short-lived move off the back of that bond buying announcement from the Bank of England. I will say in Asia, we did see some follow-through to what we saw in Western markets yesterday, in that actually bond yields were going up in places like Australia. The 10-year yield was up down about 16 basis points to 3.93%. But of course, yields in Western markets heading back in the upward direction today. In terms of equity markets, it really was mixed. The MSCI Asia Pacific Index as a whole was up about 0.2%. Part of that due to strength in Japan, but you did have weakness in other markets like Hong Kong. The Hang Seng Index actually falling to its lowest level since 2011. And the Hang Seng Tech Index in particular, full of those big Chinese technology stocks, fell about 1.2%. It actually touched its lowest level since its inception in 2020. Finally, in foreign exchange, it once again is the story of dollar strength today and weakness of other currencies, including the Chinese yuan, weaker against the dollar by 0.5%. The offshore yuan right now at 719.94 at the moment. So again, we're talking about record weakness, Matt, for the offshore yuan.
Yeah, definitely currencies still front and center here, as are yields. As a result of those two moves,
we see futures coming back down. Yesterday was a big rally, gaining 2%, back up over 3,700 on the S&P. And today, at least now, 4.5 hours away from the opening bell, it looks like traders are fading that. Take a look at the 10-year yield coming back up right now, 11 basis points, 384. So still not back to the levels that we saw overnight yesterday, over 4%, but we're getting closer. And maybe as the Bank of England effect wears off in the UK gilt market, we'll see yields float back up here as well as in the UK. So keep an eye on that. The Bloomberg Dollar Index at 1347, 1348 right now. Not at a record high, but climbing back towards it once again, very close. And NYMEX crude coming down about 1%, $81.36 for Texas Intermediate. Anna, what do you see in terms of the euro area?
Yeah, let's have a look at what was happening here in Europe, and I'll start with the euro area and confidence, economic confidence falling to 93.7. That is the lowest since 2020. Doesn't seem like long ago, does it? But boy, it's been a busy 2 years. So the weakest confidence for consumers in the Eurozone since the pandemic. That in itself is interesting, possibly doesn't tell us anything new. We anticipated that was happening. It was the inflation data out of one region of Germany that really reminded the markets of, hang on a second, before the BOE acted, what were we worried about? Inflation, that inflation data from North Rhine-Westphalia, double digit. We get the German data later on today, so the market's back laser focused on the inflation problem as we were, well, as we have been for weeks, for months perhaps. So European equity markets selling off as a result. Now, Matt is going to jump to my rescue and tell me what all of these letters stand for. But this is the important bit you need to know on the macro front today. This is the IPO of Porsche. There's a stock listing today, one of Europe's largest IPOs, up by 3.9% on the day. Not a bad performance at all, considering the backdrop for this business, standing aside from broader consumer trends. I guess we can say that about the luxury car maker P911, the very nice ticker on Porsche. Now, cool. Next, a retailer in the UK, down by 7.9%. They're warning about the weakness in the pound. H&M warning about the strength in the dollar. This currency story is starting to hit retailers here in Europe. The pound down by 0.7%. Liz Truss has been out on local radio stations around the UK today, doubling down really on her economic strategy, saying it's the right policy choice for Britain at this point. That's her view. The pound is weaker than it was yesterday, but still stronger than it was on Monday, 108.11, but down compared to the close last night. The UK 10-year yield, and Matt was talking about the impact and whether we'd see it fade, and what the Bank of England is doing. Of course, that policy intervention carries on at the longest end of the curve until the middle of October or so. But we have seen a move higher in yield, not up to 4.5%. That's where we got to yesterday, north of 4.5%, in fact, at the time when the Bank of England decided to intervene, and over 5% on the 30-year. But that's where we are. We are seeing some movement higher once again in those yields as we go back to worrying about the inflation story. Bloomberg's Lizzie Burden, with that in mind, is outside the Bank of England. Lizzie, we've heard now from the government, we've heard from the Prime Minister doubling down. What's next for the central bank?
This was a financial policy intervention, not a monetary policy intervention. Of course, the intention was to stop the gilt market spiralling out of control. But you've also had the chief economist, Hugh Pill, saying that we're going to have a significant move in terms of interest rate rises. And so at this point, the Bank of England looks like it's confused in terms of its quantitative policy, but also beholden to the fiscal policy of the government.
Well, on the subject of the government, which Anna was just talking about, the doubling down, where exactly does this leave Liz Truss? How much pressure is there on here to pivot?
Massive pressure. So Liz Truss, as you say, has been out on local radio. The audience of local radio tends to be older, so she's preaching to the choir here. She's dodging the difficult questions from the financial journalists. But her message is that the tax cuts are going to grow the economy. She's really digging in here. There's lots of pressure on her to sack her Chancellor Kwasi Kwarteng, make him a sacrificial lamb. But they're close friends as well as political soulmates, so it looks hugely unlikely. It'd be a big humiliation for her, and it wouldn't make much of a difference in terms of policy. It doesn't look like she's going to U-turn on the tax cuts, and so what does look likely is that she's going to have to rein in the spending to try and restore fiscal credibility. You've even had the former Governor of the Bank of England, Mark Carney, saying that the government's undermining the UK economic institutions, but it's going to be completely politically unpalatable to be cutting spending in a cost of living crisis. So ultimately, Liz Truss said she wanted to take on the economic orthodoxy at the Treasury. What she's facing now is the reality in the markets.
All right, Lizzie, thanks very much. Lizzie Burden there reporting from outside the Bank of England. Now, Porsche is trading on the Frankfurt Stock Exchange in one of Europe's biggest debuts in a decade. Shares open slightly higher, even after parent company Volkswagen set a top price. Lutz Meschke, chief financial officer at Porsche, spoke with Bloomberg's Tom McKenzie earlier.
We were always very strong when it comes to crisis situation, and also in the first half 2022, we had a lot of overlapping crises, Ukraine war, the semiconductor shortage, the wire harnesses shortage. And we were able to further increase our net profitability margin and also our net cash flow. That means Porsche is a very resilient company, and therefore we are quite confident to meet our forecast figures.
Tom McKenzie joins us now from outside the Frankfurt Stock Exchange. So, Tom, what does this IPO mean for Porsche and Volkswagen? What's the big picture here?
Well, Matt, I know this is hallowed ground. I feel like there's some imposter syndrome going on because I know this is an area and this is turf that you know very well indeed, and a company that you have followed through the years. So you will know this is historic for Porsche and VW. As we've said in the headlines, the largest IPO in at least a decade for Europe, one of the top 5 ever in history. So they've raised, the market value is about 75 billion. The shares, as you say, popped a little above the top end of the market price. 82.50 is how they priced it. We're above that now in trading. They've raised about 9.4 billion. Their group, the VW group, are going to be putting a lot of that towards electrification, software, digitization. The Porsche family, interestingly, are now back with a significant stake in Porsche, 25%, with blocking rights as well. There are concerns about governance because you have the CEO of Volkswagen, who's also the CEO of Porsche. Question marks about just how independent this company will be. They've set themselves, Matt, a target of about 39 billion euros of revenue this year. The CFO saying he's confident they can continue to meet that. And of course, question marks as well around how aggressively they're going to electrify the brands, particularly the SUVs. So yes, P911 is the ticker, and they issued 911 million shares. Anna.
Yeah, very nice ticker. What does this tell us about the European IPO market, European IPO activity, Tom? Is this a real turnaround, or is this just a standalone Porsche exclusive?
Yeah, I'm not sure if it's exclusive to Porsche. Bloomberg put out a note saying that certainly their expectation is that really IPOs in Europe aren't going to pick up until the first quarter of next year. But it will be those companies like Porsche that have that mature business background and that have profitability that can still tap into these markets and do well. And we're seeing that reaction from Porsche today. Eni is one European company to watch. They may be spinning out part of their renewables business later this year. ThyssenKrupp also have a unit that maybe they will look to IPO as well. The context is, Anna, that you've seen an 80% reduction in terms of IPOs year to August this year versus last year. And raising about 10 billion euros, so significantly down on the previous year. This has brought in an additional 9.4 billion. It's almost doubled that. So will it mark a big turnaround? I don't think so, but there may be a few other companies that look maybe to tap the markets, again, if they have that profitability that they can prove.
All right, Tom, thanks very much. I am indeed jealous, but I'm glad to have this story in your trustworthy hands. Bloomberg's Tom McKenzie there outside the Frankfurt Stock Exchange at the historic IPO of Porsche shares. We're going to have more of Tom's interview with the chief financial officer, Lutz Meschke, later on in this hour, and I think that's one that investors are really going to want to listen to. Now, let's get to some more general news in the U.S. Hurricane Ian has weakened to a tropical storm, thankfully, according to the U.S. National Hurricane Center. About 2.3 million homes in Florida still without power. When the damages are added up, it's expected to be one of the costliest storms in U.S. history. Bloomberg Kriti Gupta joins us now for more. So, Kriti, what do we know?
So it is a tropical storm now, but it's still extremely dangerous. The types of storm surges that you're seeing, a lot of the damage has already been done for a lot of industries. Let me walk you through the numbers here, starting with the property insurance industry. Get this, $20 to $40 billion in claims. It could be one of the costliest for this industry. And remember, it's used to hurricanes, especially in Florida, but this one especially hurting that specific area. And now, of course, the demand picture is crucial as well. Florida is the 4th largest state economy economy in the United States. It's also the fourth largest in terms of driving demand, gasoline demand, and that's going to be really crucial as well. This idea here that if you are actually losing some of the demand, people evacuating, people perhaps not driving their cars because of the storm, that's going to hit oil demand as well. The question is for how long, especially as a lot of places in that area are still closed for another week or so as the tropical storm pushes through. The other one, Matt's going to love this, a trading spaces reference. Orange juice futures are...
Trading Places is the name of the class.
Trading Places. I'm so
Good
sorry.
effort, Creedy.
I tried.
Oh.
I really did try.
Oh my goodness.
I should get a trophy for trying. Trading Spaces is a show on HGTV, which I also loved, I have to point out. Nevertheless, up about 15% on orange juice futures because 90% of the U.S. orange juice crop is right there in Florida. So you do see a little bit of pain there as well. I'm going to leave you with one last one, Mosaic, the fertilizer company. A lot of their operations are there where they turn that crop into fertilizer. All of that is in Hurricane Ian's path.
It throws just the right amount of shade on Matt, though, Critty, if you get the name wrong. What about stock market impact then? We talked about commodities. What about the stock markets?
Well, when we're talking about individual movers, Mosaic is the one you really want to keep an eye on. Bloomberg Intelligence saying that they could see as much of third quarter revenue fall by $240 million to $300 million. So once again, a lot of pain for Mosaic, specifically because not only are their phosphate rock assets there, essentially that's where they mine a lot of it, but also because this is coming off of a lot of the pain that they're dealing with from the natural gas demand. Think about this, the war in Ukraine affecting the fertilizer crop because you need natural gas to make that change. So right now, Mosaic is the one you want to keep an eye on, as well as, of course, some of those oil stocks and oil demand, as well as the pain in refineries.
All right, Bloomberg's Kriti Gupta not making me ultra optimistic about the flight I'm supposed to take to Miami tomorrow, but we'll leave it at that. Thank you so much. Now, Kriti was talking about some of the stocks moving due to Tropical Storm Ian, but there are some others moving in pre-market trading here in the U.S. as well, including Carnival Cruise Lines, which, of course, big cruise operator, a lot of those out of Florida. It has had to cancel cruises, alter courses as ports are closed on both sides of the state. So as a result, that stock is down about 2.4%. It is part of that ultimately $7 billion hit that could come to Florida's tourism economy. In terms of other stocks moving down, we already talked about the cool ticker P911. Another ticker here in the U.S., Race, which is Ferrari, is also down. Interesting to see this stock down about 3.7% on the day of Porsche's IPO and trading debut. And finally, I just wanted to check on Apple as well because, of course, it sat out the gains we saw in the broader market yesterday due to concern around iPhone demand after that Bloomberg scoop that it has decided to stop its plans to increase production of that new model iPhone. So after losses yesterday, we're seeing that stock adding to losses this morning as it's really just a downward trajectory for broader markets and big tech in particular, Anna. Right now, it's off by about 1.3% before the bell.
Okay, we'll keep an eye on that one. Coming up later this hour, we will talk about the ECB and its policy choices ahead. Governing Council member Martins Kazaks joins us live on the programme. And next, Britain's crisis of confidence has been years in the making. More on today's big take story next. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China. But African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, of the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window. They have thorns on them.
The markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. So Britain is facing a crisis of confidence from the financial markets, which actually has been years in the making. Today's Big Take looks at the sudden desertion of trust from financial markets after the Truss government revealed its economic plans and the history behind that. Bloomberg's Philip Aldrich joins us now with more. And Philip, we've heard the Prime Minister doubling down on her commitment to the policies that were announced last week. So for anyone who was expecting some sort of U-turn, that's not been the direction of travel so far from the British government. But as I said there in the introduction, these concerns about the UK, long in the making, what's the backstory behind those?
Yeah, so it's all a question of fiscal credibility since the mini budget on Friday, and that's what spooked markets. They just don't believe the government's word, the Tory party's word any longer. That's the party of sound money, it's traditional fiscal credibility compared with the Labour Party. That's been the sort of framework of people's and markets thinking. Of course, what has happened since, effectively, you can look just before the Brexit referendum in 2016. There's been this kind of lackadaisical attitude towards that referendum in Scotland, which was an existential threat to the UK. Then you had sort of a loose connection with the truth in some of the campaign statements during the Brexit referendum, and all of this is starting to erode confidence in the structures of government. And obviously, in Boris Johnson, and then went a little further. There was the tax on the judiciary, and we've had questions about experts for quite a while now. And then, of course, Liz Truss in the campaign trail just went, all guns blazing against the experts, talking about the Treasury blob, the institutions of the Bank of England, and the fiscal watchdog in the UK. All of these were kind of raised, just put under question by the government, and that combined with the sort of fiscal indiscipline in terms of just laying out the tax cut side and not actually saying how we're going to get the money back. So huge amount of borrowing. Yeah. Trust us, guys. We're going to bring the public finances under control. By the time after that sort of 6 years of erosion of confidence, nobody trusted them at the end of it.
Okay, so the trust was not there. Matt, jump in.
Well, I heard Valerie Teitel earlier this morning kind of comparing the Truss economic plan to Reaganomics, and I'm sure that she would be flattered. I'm sure that's what they're aiming for, basically. But the British government, especially post-Brexit, in the midst of this incredible inflation, is in a very different position than the U.S. government was after Volcker had already stopped inflation, when everybody wanted to buy treasuries, and our currency was strong. We had a current account. We had extra money in the current account. So why are they doing this now? It seems like the worst time to make this kind of economic decision.
Right, so the government believes that actually compared with the G7, we're in a relatively strong position because our debt to GDP ratio is below all other G7 members except for Germany. So you start from that relative strength, and as this, as sort of international economics ends up becoming a bit of a sort of competitive game, that's the bedrock of why they think they can push ahead with this kind of, these spending cuts combined with the other big part of the reforms are supply side changes. So they're deregulating the city. They're going to deregulate all sorts of things from childcare to agriculture. These details were not in the Friday statement, but they are going to be coming out in the next few days. And you combine that with what they're going to where they are going to backtrack a bit is well, they say that it isn't backtracking, but they are finally going to make some statements on what they're going to do on how to find savings to make the budget balance or just come into balance a little bit more. So the combination of evidence of growth reforms, the sort of strength of the debt to GDP ratio, relative strength of debt to GDP ratio, and some of the fiscal, some of the savings that they'll find, that's how they are going to explain, and they hope what they're doing, and they hope that markets are going to start to buy it. That's the aspiration, that kind of confidence will be restored because people will begin to understand the strategy. As you say, Reaganomics starts from a much stronger position, so that's the big question. I mean, are people going to buy it?
Yeah, so are people going to buy into this strategy? We just have to wait quite a long time for the detail, and that seems to be something that the market is concerned about as well. Thank you very much. Thanks for joining us, Philip Aldrich. I should just also point out to Matt, the opposite of a deficit is, of course, a surplus, but sitting here in the UK and the US, as we do, it's easy to forget these words. Philip, thanks very much for joining us. Look for the full Big Take story, NI Big Take, on the Bloomberg terminal, and you can read much more detail about the backdrop to what's been happening in the UK over the past week or so. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry cost $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
A $7 trillion industry. There's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg. A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
The impact of the BOE's bond buying announcement not lasting long. Yields are back up, the dollar is back up, and stocks once again are heading south. We're going to discuss all of that with Hannah Gooch-Peters, Sanlam Investments Global Equity Investment Analyst. She's going to join us next to talk about what is going on with the markets, whether we have seen the peak or the bottom in anything yet. That's coming up next. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. British Prime Minister Liz Truss stands by the tax cuts, saying urgent action was needed to get the economy going. Now the question is whether her government can restore credibility with investors. Porsche goes public. Shares of the sports car maker begin trading after Europe's biggest IPO in a decade. And Hurricane Ian has weakened to a tropical storm after pummeling Florida with catastrophic winds and a deadly storm surge. It is one of the costliest storms in U.S. history. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. And risk appetite just taking another beating then, it seems, Matt, as we're all reminded by some fairly regional German inflation data about our big preoccupation globally around inflation and prices.
Yeah, I mean, huge. I think it was 1.8% month over month, I believe, for North Rhine-Westphalia. So it's a very big state in Germany, and it's a huge number. Nonetheless, I think there are a lot of other factors contributing to the drop in futures this morning. We had a major rally yesterday, almost 2% on the S&P, pushing us back above 3,700 in the cash trade. Now we're down about 0.9% in futures. So still 4 hours away from the open. And of course, the volatility means that these numbers change a lot, sometimes within a matter of minutes, let alone a matter of hours. Nonetheless, risk appetite seems very low. The U.S. 10-year yield rising to 383, 384. So at least, I guess, investors are selling bonds as well and not buying those in preparation of major catastrophic economic consequences today. And you see the Bloomberg Dollar Index continue to climb, 1346. Maybe that's a safe haven aspect of where they're going. We're not quite at a record again on the dollar index, but we are not far away. And then NYMEX crude. Critty was saying earlier, you know, the hurricane in Florida, now a tropical storm, I believe, does mean that far fewer people are driving, so less demand for refined crude products, and as a result, Tex Intermediate is off to 81.99. Kaylee, what do you see in the pre-market?
Well, no surprise, Matt, given that yields are moving back up and risk sentiment, as you and Anna were saying, is not so great this morning. We are seeing big tech stocks in particular dragging down the markets here in the U.S. The likes of Apple, which of course also sat at the gains of yesterday on concerns around iPhone demand after a Bloomberg scoop that it is abandoning its plan to increase production of that iPhone 14. So it is down another 1.4% today, and you have other big tech players down as well. Tesla is down about 1.75%. Both Amazon and Nvidia each down about 1.4%. And as we know, these are huge heavy weightings in the U.S. markets, Anna, so the direction they're going largely is the direction the broader market goes.
Right, so we'll certainly keep an eye on those then, Kaylee. Here in Europe, we're caught in a sort of downdraft today, down by 1.3% on European stocks. And I mentioned the German inflation data, even that weaker than anticipated inflation print out of Spain, not enough to counter that sort of mentality that we've got in markets where inflation prints exceed expectations or exceed the previous month. That just reminds us of what we're all dealing with. The UK 10-year yield, a lot of focus on UK assets, of course. Yesterday it was the 30-year. That's where the Bank of England jumped in and intervened. That got up to more than 5%. That yield is now weaker than that, around the 4 or so. But the 10-year yield also was brought down by that Bank of England action. We were at 4.5% yesterday, so we're not back up to those levels. But as we see the immediate impact of the Bank of England action wearing off a little bit, we do see those yields going back up a little, and we're at 4.15 on the UK 10-year. Now, this is Porsche. Ignore all the words and the letters in front of the name, but this is the Porsche share price listing today.
Don't ignore them.
Our colleague. Don't ignore them.
Those
I apologise, Matt. You can explain. Excellent. You can explain what they all mean. But this, for the uneducated, I include myself amongst that, Porsche is what we're looking at here. The share price up by 4.2% compared to where it started the day, of course. No closing price from yesterday, but versus where it opened the day, it is up by 4%. Not a bad performance in a market that is falling by 1.2%. And next, this is a different story. This is a clothing retailer aimed at a very different part of the market over here in the UK, down by 7.3%. They are concerned about weakness in the pound. H&M concerned about strength in the dollar. All of those FX market moves then, Matt, coming home to roost for UK retailers and global retailers.
I think you're right that we can shorten the name of Porsche just to Porsche. But to explain, the whole company officially is called Doctor of Engineering Honorary Title Porsche Stock Corporation. And
I am glad you're here.
Well, what I think is strange is if you get an honorary degree, right? I think he was awarded an honorary engineering degree by the University of Vienna in 1917. It's nice, but you don't put that like on your door, right? Because
you wouldn't do that.
No, it's an honorary degree. Anyway, I may misunderstand slightly. There are cultural differences, I'm sure, and also historical differences in honorary degrees. Nonetheless, we should change that to just straight up Porsche AG at the very least. Let's bring in right now Hannah Gooch-Peters, Sanlam Investments Global Equity Investment Analyst, to talk about what we've seen yesterday, a big rally here in the U.S., Hannah, and really relief in the U.K. as well as after the Bank of England stepped in. Does that relief wear off? Do we fade that in today's trade because, nothing's really changed other than the fact that you've got, sort of a mini QE3 back in London?
I think that what yesterday investors were looking towards, which is why we had buoyancy in the market, was a bit of stability, a bit of relief that there was some sort of intervention. But I think reality has hit home again today, and I think that's why we're seeing so much weakness. I mean, ultimately, investors don't want to see this kind of volatility, the extremes, the uncertainty in the markets, and I think that's ultimately why one of the big reasons why we're seeing so much weakness again, particularly in local UK domestic stocks.
Yeah, if we're looking, Hannah, good morning, good to see you. If we're looking for response from UK authorities, is there a role for the Bank of England to do more here in terms of interest rate hikes, or is just the damage that would do to the housing market means it's not the way to go? What are you expecting to see?
Look, ultimately, I'm not an economist, but for me, I've just got to look at the impact it's having on the UK equity market as a whole. And I think that the drawdowns you've seen, particularly in some of those UK domestic stocks, if you look at companies like Taylor Wimpey, like Barratt's, they're very weak again today. And they have seen, if you look in dollar terms, they've seen 60% pullbacks this year. And it's really quite staggering. The sort of turmoil that you're seeing in the UK market is certainly warranting some sort of intervention, some sort of stability. But, ultimately, that's not my call.
Right. I mean, we were talking yesterday, and I wonder if you could weigh in on this about whether we should call this a crisis. Clearly, it feels very much like a crisis situation in the UK, and we're seeing crisis policy responses. There was certainly some sort of crisis going on in gilt and pension products yesterday. But is it broadly, globally, is this a crisis, or are we just dealing with a bear market and a very rapid rising interest rate environment? Is that, by its definition, a crisis?
I think what we're dealing with is somewhat more of a natural reset. So what we had, if we go back, and it's so easy to try and forget about this, is the extremes we had in terms of stimulus in the economy during 2020 to deal with the pandemic. I think that we needed a reset, valuations got so expensive. And now what's happening is that it's almost like a natural environment. We're starting to see the wind come out of this. We're starting to see things come to a more normalized situation in terms of valuations, in terms of where stocks are trading, essentially.
So you think valuations are now at appropriate levels, Hannah, or do you expect to see further compression on that front?
So I think actually, if you look at the S&P 500, for example, and let's take a price to sales ratio, you've come from extreme levels where you were something about 20% above where it was trading in 2000 levels to level with 2000. So that really does put it in perspective. So we've gone from extreme levels to expensive levels. But the good news is if you look into certain subsectors, parts of software, for example, in the US, parts of healthcare technology, you've seen huge pullbacks in certain sectors of very high quality businesses, which is the first time we've seen more reasonable valuations for names like Thermo Fisher, for names like Intuit, Adobe, in a number of years, which is starting to actually make us really excited.
Well, let's talk about the earnings part of that earnings multiple equation. Hannah, how much of a deterioration are you expecting in corporate profits, and how does a stronger dollar factor into that?
I think the stronger dollar really is going to have a big impact on earnings going forward. And, you know, for us, looking at names like Elevance Health, for example, or like Fiserv that have very good 100% dollar earnings, particularly has been very beneficial to investors, say, over the last 2 years. Name like that, like Elevance, for example, healthcare insurance up at 85% in dollars over the last 2 years. And so they're really benefiting. But what you're going to see now as a result of that dollar strength is that pressure on companies with international earnings. And so that's going to start to give you opportunities in companies that have been trading that's more expensive valuations. But of course, the market will have a reset as a result.
Earnings expectations really need to come down. Speaking of resets, forecasts really need to come down, right, Hannah? I mean, we're looking at a median forecast of 4,300 for the S&P year end, and we're just over 37.
Yeah, so I think that, like I said, I think we are going to have that reset. I think you're starting to see it. We've seen it in companies like FedEx, for example, like Ford. You're starting to see that reset come through, but it's not really featuring yet. So I think as that comes through, you're going to start to really see profit warnings maybe from some of the bigger parts, the constituents of the index, which will drag down the index overall. So I think we do need to be cautious in terms of overpaying for stocks at this point in time. Like we've had a 20% pullback, but you know we're coming from very elevated levels.
Okay, thanks very much, Hannah. Thanks for joining us. Hannah Gooch-Peters of Sanlam Investments. Coming up on this program, we will be diving a little further into what's going on in the ECB story. Martin Kazak's Bank of Latvia governor joins us. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, have fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
It's such an interesting new world. The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
we feel like we can maybe help people out more.
We have an enormous number of big ideas.
If you're not really in this space full time, I think it's very hard to run a successful crypto fund.
Seeing these inflationary pressures, and I don't see, like, when I look at the underlying inflationary pressures that are broadening, I would say my choice would be 75 basis points.
That was ECB Governing Council member Simkus speaking with Bloomberg's Danny Berger earlier today. Let's get a conversation now going with another ECB Council governing member. Martins Kazaks, governor of the Bank of Latvia, is joining us now from the Future of Central Banking Conference in Lithuania. Mr. Kazaks, thank you so much for being here. There is the mechanism to which you get to neutral, the size of the hikes, which apparently broadly there seems to be consensus forming around 75 basis points. But there also is a question of where exactly neutral is. Where is it for you, and do you think you will get there by the end of this year?
Well, there are various estimates. Of course, this is an observable. It's like yet nobody has ever seen it, but the estimates are in the range of 1 to 2%, we typically most use. So I think by the end of this year, we would get to the upper side of this range. So 75 basis points is a big step, but I think that would be appropriate at the current moment.
Okay, and you think that for October, good to speak to you, Governor. You've said that at the moment you'd be closer to 75 basis points. What is the best argument that you can use to take other members of the Governing Council with you in that? Because others we've spoken to this morning have been talking about lower numbers than 75.
I think we are still providing the accommodation to the economy. The rates are still in the accommodative part of the range. So removing that would be necessary at the moment. And of course, currently the distance to the interest rates that would ensure 2% inflation over medium term is still relatively wide. So we can take big step to speed this up. So the front-loading story, bigger step story, I think still plays out. And later on, when we approach higher levels of interest rates, of course, when we have the two-sided effects of tightening too much or tightening too little, then the steps would become smaller and more cautious. But we are not there yet.
Okay, and how aggressive should other measures be as well, Martins? I mean, we're looking at CPI, I know in Latvia, some of the highest levels around the Eurozone, 21.5%. But of course, the policy must be set for the whole Eurozone. How does quantitative tightening play in here? We've heard what Christine Lagarde, President Lagarde thinks about when QT discussions should start. When do you think those QT discussions should begin?
Well, internally, as everybody, we should do the homework, so we should discuss now, but it doesn't mean that we should communicate this already as a step that we make. I think at the current juncture, moving with interest rates, hiking the rates, is a more appropriate step. And then towards the end of the year, of course, the possibility of starting QT elements would be more ripe. But by all means, we would need to move to the balance sheet instruments as well, because of course we will want to work more with the long end of the yield curve as well.
You see pressure, though, to Anna's point. You know, other parts of Europe are going to have trouble with higher rates. Italy, for example, facing renewed pressure in its bond market after the election results over the last weekend. Does this mean you're going to deploy the TPI, the transmission protection instrument?
TPI is not meant for for all kinds of volatilities in the market. It has certain conditions for it to be turned on. And of course, if there will be need in the financial markets, we will consider it. But political changes that affect the policies does not necessarily qualify as market volatility, which is not fundamentals based. So we always have these backstop instruments available, but it is not that they will be employed in every and each case. And if you currently look at the financial markets and coming back to the rate increases, we've seen that the 50 basis points, 75 basis points were taken by the markets relatively confidently. And that also provides confidence to me that 75 basis points would be an appropriate choice for our next meeting.
But is there a spread over bonds that makes you, that triggers the TPI if you're looking at 300 basis points or 4?
We do not have,
No.
We do not have specific spread levels that would trigger specific instruments. And let me remind you that we have at least 3 instruments in this area. One is PEP, reinvestment flexibility, and then we have your mentioned TPI, but we also have the OMT.
Okay, so clearly you are watching spreads and the bond market. Let's talk about foreign exchange as well. How concerned are you about the depreciation of the euro?
Of course, weak euro does not help with inflation because it prices inflation into longer run through energy prices and all other imports. So it is a problem. But at the same time, when supply side gets fixed, when supply chains improve and get back to normal levels, weaker euro may also help as a hedge against deeper inflation. So yes, it does worry me. Of course, we do not have specific exchange rate levels that we would target, but this does come into the inflation forecast, and weak euro does increase inflation. That is very true.
Governor, I'm sitting here in the UK, and clearly there's a lot of turmoil in UK assets at this point. I wonder if you're watching that situation, if it teaches us anything useful about exits from easy monetary policy, about QT, or about fiscal actors and the types of policy they should introduce right now.
By all means, it teaches us a lot. It shows us that doing homework is very important before we move with specific instruments. Understanding the interlinkages is extremely important. It's also extremely important for the central bank to move in when it's necessary for financial stability reasons. But at the same time, of course, it also tells us a lot about the policy mix. What is the efficient policy mix? What is the role of fiscal policy? What's the role of the monetary policy? And of course, there's macroprudential, and I would also say structural policies. And in the past years, when we saw that, the COVID-19 crisis, fiscal policy and monetary policy going by and large hand in hand, and there most likely is some blurring of the lines. What is the task of each of the policies? So I think it very clearly says that independence of the central bank is paramount, and clear mandate is extremely important to deliver efficient policy mix that can carry us through different volatilities in the markets and in the economy.
All right, Mr. Kazaks, we have to leave it there, but thank you so much for giving us some of your time this morning. That's Martins Kazaks, Bank of Latvia Governor and ECB Governing Council member. Thank you so much. We do want to quickly touch on some breaking news out of China. China's state banks have been told to stock up for yuan intervention. This is according to Reuters. And off the back of that headline, we are seeing a massive move in the offshore yuan. At one point, it was north of 7.21 against the dollar. It is now back down, strengthening to 7.15, and the dollar is heading back toward the lows of the session as well. Intervention seems to be the story around the world. This is Bloomberg.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else.
It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
Shares of Porsche began trading today after Europe's largest IPO in a decade. Lutz Meschke, chief financial officer at Porsche, spoke with Bloomberg's Tom McKenzie.
We have successfully mastered one of the biggest, largest IPOs in Europe ever. And yeah, therefore we are very proud. And yeah, I would like to say thank you to our entire team whose work has ensured that we can stand here today.
And I cast my mind's eye back to 2018, 4 years ago.
Yeah.
And you came out and said, maybe we should IPO Porsche with a market cap of around 80 billion euros. There was a bit of pushback internally, externally, when you came out with that. Do you feel vindicated?
Yeah, absolutely. It was a tough fight over 4 years now, but we succeeded. Now we can stand here. We are very happy, and we see further potential for the future with our strong brand.
How are you going to cooperate between the parent company, Volkswagen, and Porsche? You have a little bit more independence now, but we know historically there's been tension between the brands and the portfolio. How are you going to cooperate and make sure there are synergies that work for you at Porsche?
Yeah, we have negotiated an industrial cooperation contract with VW, and there's clearly regulated that Porsche has 100% autonomy in future. The Porsche board will decide in future, completely independent from VW. And yeah, that's a great situation for us. We want to unlock Porsche's full potential, of course, but we have also the possibility in future to work together with the VW group brands where beneficial for Porsche. That's the case when it comes to sharing technologies like the Taycan used also for the Audi e-tron GT, pooling emissions, bundling purchasing volumes, or also using production capacities like the Cayenne in Bratislava.
Okay, and talking about production, so you have the factories in Germany, you're producing in Slovakia. Where do you build out the factories of the future for Porsche?
Yeah, hopefully in Germany and in Slovakia. There's no other plan.
That's Lutz Meschke, the CFO of Porsche, speaking to Bloomberg's Tom McKenzie. Keep an eye on metals prices. The LME is consulting on a possible ban on Russian metals. That is sending some of those metals prices higher this morning here in London. So as we hand over into New York, keep an eye on that. That is it for the early edition. More surveillance is ahead. Tom, John and Lisa will take you through the latest market moves. This is Bloomberg.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
I think the Bank of England's been backed to some extent into a corner by unorthodox fiscal policies.
The BOE really needs to keep a hawkish eye on inflation and in controlling inflation.
Markets aren't stable, inflation changes everything, and governments, central banks are going to try all kinds of things.
Global markets moving 20, 30, 50 basis points off of one data point. I think that in and of itself is an indication of dysfunction.
Today, we're seeing, the economics of pandemonium.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What a messy time, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Futures down 0.8% on the S&P. TK, this market all over the place.
Yeah, for me, it's that the crisis is not over. It continues today, but John, it is different today. There is some stability to the markets as everybody hangs on every word we could hear from the Prime Minister and the Chancellor of the Exchequer.
The lady is not for turning, Tom. I imagine that might be the headline next week, the week after that. How long will that be the headline for? And at what point, Tom, will someone blink here? I think there's conflict all over the place. Mohamed El-Erian talked about it yesterday. I think he framed it perfectly. Tom, for the central bank, the Bank of England, how do they tackle inflation and address financial stability risk simultaneously at the same time?
Let me be more direct, John. They're trying to redux Reaganomics 1, and somehow they're going to get to Reaganomics 2, and they're bailing it out. I would point out, John, that this was a 7 standard deviation move that caused this. I think that Carl Weinberg, who will join us later, had the single best clarity of anyone out there. He said, it's real simple. You liquidate bonds for cash. That harkens back to the crises of the 90s.
Lisa, when the risk is in, the risk-free asset. That's what we're experiencing at the moment.
Yeah, there was this great point that Jim Reed over at Deutsche Bank made this morning where he said, how could you have earned a 42% return from a AAA rated investment? Simple. At any time between 8 and 11 a.m., all you had to do is buy 40-year gilts, and then you'd be fine. And honestly, how much does this highlight the volatility in a market where, to your point, the benchmark securities are flipping around as though they were Bitcoin?
Penny stocks all over the place. Can the Bank of England meet the moment? Tom alluded to this, and I think this is really important. This concept of fiscal dominance. Has the Bank of England contributed to the perception of fiscal dominance in the UK? And is that something, Lisa, they need to push back against and push it back against pretty hard?
And this is why I was actually kind of shocked. Danny Blanchflower, who's always for easing policy, was saying that what he would do right now is an emergency 100 basis point rate hike by the Bank of England to try to shore up that credibility. What you're finding right now is after decades of monetary policy being able to plug deficits, being able to plug the gaps by fiscal policy, they've run out of time. And all of a sudden, deficits matter in a way that they haven't in the past. And this is going to be a theme not just for the UK, but for many other developed nations.
Equities this morning, and good morning to you. They are down. They are down again by 0.9% on the S&P. Big day of gains in yesterday's session. We unwind some of it. On the Nasdaq, we're down by 1.2%. Yields are higher again by 10 basis points to 383.60. I tell you, the range on the 10-year in the last 24 hours has been huge. Euro dollar negative 0.4% on that currency pair, Lisa, 96.92.
And honestly, the way that things have been moving around makes it so difficult to pin down what's even important to be watching at a time when, if you get some sort of UK emergency intervention and possibly uncapped buying for a limited amount of time, maybe before a possible rate hike, it's very hard to game out the direction of where things are going. The direction of the data, though, does seem clear. At 8 a.m., we get German CPI, and the latest print, it looks like anecdotal data that came out earlier this morning seems to suggest potentially a 10% CPI in Germany. That would be the highest going back in data to the 1990s and way beyond that. How much does this change the scenario? Because yes, a lot of the central banks don't want to see systemic dysfunction, but they also don't want to see 10% inflation, especially at a time when it's unclear what's going to stop it, considering some of the concerns on the energy front. At 8:30 a.m., we get U.S. initial jobless claims, U.S. GDP on, this is the third read, as well as personal consumption and core PCE for the second quarter. I am watching claims. I want to understand, do we start to see more of them tick up? You know, Liz Ann Saunders put out a really interesting chart yesterday, and she put out an interesting article where she was talking about how there are signs that there are cracks, pretty big ones, forming beneath the surface here. Who are losing their jobs? Are these full-time jobs that they're losing and then they're going into part-time employment so that a lot of companies don't have to pay benefits? That's something that she's been observing increasingly. And today we get some earnings, particularly from retailers. Bed Bath & Beyond is at 7:30 a.m. and then Nike after the bell. We also get from Micron Technology, the whole semiconductor story here. How much does that edify the feeling that we got from Apple, John, that we're getting a slowdown in demand for smartphones? We're getting a slowdown in demand for devices, a slowdown in demand for cars.
Yep.
How much does this really highlight the other side of the big tech story, the earnings side, that would be the other shoe to drop?
Mike Wilson and Morgan Stanley, you know it, Lisa. He's been talking about it for a number of months now. Lisa, thank you very much. Dean Kernick joins us, founder and CEO of Macro Risk Advisors. Dean, you are the guest we wanted to talk to this morning. What do you do when the risk is in the risk-free asset?
Yeah, this has been a theme that we've been looking at closely, John, for over a year. And I think the observation you could have made is that the global markets were transitioning from this environment in which the correlation between stocks and bonds was so friendly for the 60-40 portfolio. They mitigated one another, these two assets. And I think the key observation was that as the volatility of both assets was going to increase, so too was the correlation. And so for the 60-40 portfolio, that's quite an accelerant to the overall vol of the portfolio. I think there's a couple of things you're supposed to do here. First of all, when market prices react as violently as they have, I think you have to recognize that these prices aren't just a cause, they're an effect. In other words, they motivate action. They motivated action from the BOE. I think you're supposed to really step back and first observe that equity prices are lower, so the entry point is better. We really don't know what's going to happen. But we also obviously see that there's a lot more vol in the markets. And so by doing nothing, you're effectively taking more risk. So you're supposed to either de-risk the equity portfolio, move up in quality. I think you're supposed to take a look at holding pattern trades. And I just look at the 2-year note yielding 4.2%. Not a bad place to be. I think at the end of the day, if this financial dysfunction gets bad enough, the Fed is going to have to blink. Every central bank, you saw it from the BOE, they will have to play some role in financial stability. And so that 2-year note's a good place to hide out, I think.
Dean, I had a beverage of choice in my hand in 2008 as I looked at slews and kurtosis of all these dynamics. You did the same thing. And the bottom line, as you just said, is this comes over to central bank policy and theory. Back then, it was a 4 standard deviation move. Yesterday, we had a 7 standard deviation move on UK gilts. Is that enough to move Chairman Powell to amend and adjust the dialogue and to amend and adjust the policy?
I don't think yet. But again, I think this move in the back end of the gilt curve is shocking as could be. We're all trying to outdo each other in terms of the stat that resonates the most, and I'll just throw mine at you, which is the 5-day realized vol on the gilts market on the 30-year at least is 10 times the 5-day realized on Bitcoin. So these are volatile times. I think one of the things we're supposed to watch is correlations with respect to rates and all other risk assets. And I think if you see U.S. real rates rise to the extent they have and with the speed they have and the negative reaction to equities, at some point, it's hard to know when, but at some point, even the Fed blinks. We don't know if that's going to happen, but in the meantime, you're supposed to take a real good look at your equity portfolio. And of course, Tom, you know, we specialize in derivatives. The interesting thing is the derivatives markets are actually providing some really, really compelling entry points in what I would just call risk-managed equity. There's an old trade called the collar. You buy a put and you finance it by selling a call. The setup on that trade is as compelling as I've seen it in 2 decades. It's quite a fascinating setup. And if you're going to dip your toe back into the world of risk, and let's just use the S&P as the starting point, you can put the boundaries, you can put the guardrails up on your portfolio at pretty efficient prices right here.
Is this the black swan trade? And I ask because John started by saying, what do you do when the risk is in the risk-free assets? And traditionally, that has been the recipe for a massive financial market meltdown. That is the recipe that we have needed to see, is when the risk is in areas that were perceived to be risk-free. How much is this the black swan trade that you need to be putting on?
Yeah, I think it's the black swan trade in terms of its impact. If we look at correlations, they're just all wrong way in terms of U.S. rates and what it imposes on all of these corollary assets, BTPs, JGBs, gilts, and then of course the dollar. Everything's wrong way correlated to the dollar as well. I would say if you're making the black swan trade on the risk-free asset itself, you're just going to be up against the Bank of England, right? At some point, these prices matter and they will react. And I think the central banks can overwhelm the market as they did yesterday. And so I think you're fighting a very difficult battle there because the worse things get, the more likely they are to respond. I think better to focus on the impact of higher rates. And I think where we're trying to figure things out, we've got earnings season coming, is how much of the mortgage payment shock, how does that reverberate through the U.S. economy? We're still printing record earnings. We're very strong earnings. We still have a very tight labor market. So the question is, how much of this ultimately translates into U.S. economic and thus corporate weakness? If that does occur, that's the next leg down. I think that's what you're supposed to play for and hedge against.
Hey, Dean, awesome to get your thoughts this morning. Thank you, sir. Dean Kernod there of Macro Risk Advisors. Tom, I think it was Ed Yardeni that said it recently. The bond vigilantes are back. He coined that term a number of decades ago, and they've made a comeback in the last few weeks, that's for sure.
This is something we're going to cover. I don't want to do it right now, John. We got to keep the show moving along. But, folks, the Bloomberg here really shows the vigilantiness of the moment. And we saw that in spades yesterday. And, John, this is the naivete of politicians. They don't understand that the market, and critically the market plumbing, all of a sudden forces clarity and new decisions.
Financial stability risk, front and center. On the S&P, we're down 1%. From New York City, Sebastian Page is coming up in the next hour of T. Rowe Price. Looking forward to that with Tom Keene and Lisa Abramovitz. I'm Jonathan Ferro. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Ian has been downgraded to a tropical storm after coming ashore in Florida with a deadly surge of water and catastrophic winds. When the damages are added up, it's expected to be one of the costliest storms in U.S. history. About 2.3 million homes are without power. The storm is forecast to move across central Florida and emerge over the Atlantic Ocean later today. It's expected to approach the coast of South Carolina on Friday and then move inland again. British Prime Minister Liz Truss is defending that package of tax cuts that sent markets into turmoil. Truss told local radio stations in the UK it's facing difficult economic times, and the government had to take urgent action to get the economy growing. Despite the collapse of the pound and a surge in borrowing costs, Truss says she's confident the government has done the right thing.
Porsche has gone public. Shares of the sports car maker began trading today after Europe's largest IPO in a decade. Parent Volkswagen raised more than $9 billion, pricing the stock at the top end of the initial range.
There's clearly regulated that Porsche has 100% autonomy in future. The Porsche board will decide in future, completely independent from VW. And yeah, that's a great situation for us. We want to unlock Porsche's full potential, of course, but we have also the possibility in future to work together with the VW Group brands where beneficial for Porsche.
The offering valued Porsche at $73 billion. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
Those numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today. It's going to be short-term.
Bloomberg Markets, The Close, weekdays on Bloomberg. A $7 trillion industry. There's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg. Business news breaks.
The IMF calling out the UK on fiscal policy.
A shot across the bow to the whole Liz Truss administration.
The Bank of England acted amid concerns a Wednesday cash call would trigger gilt crash. John, I've never seen that headline in my life.
Trust Bloomberg for the fastest coverage and instant expert analysis.
They're doing it to try and stabilize the market, but they're having very little effect.
The term is kind of quantitative conundrum.
We are now in chaos.
For continuing coverage, keep it tuned to Bloomberg Television and Radio.
Buckle our seatbelt even tighter, and we have to recognize that policymakers are no longer repressors of volatility, but they contribute to volatility, and that this journey is going to be incredibly bumpy.
Mohammed El-Arian, just fantastic on Bloomberg TV and Bloomberg Radio yesterday of Queen's College, Cambridge. Live from New York City this morning. Good morning, Tom Keene, Lisa Abramowitz, Jonathan Ferro. Futures down almost 1 full percentage point on the S&P. When Turkey is commenting on your currency, you know you've got problems. Erdogan coming out and saying the British pound has blown up. This from a leader of a country who said yesterday the central bank rate will have to fall further. Tom, just a bizarre situation at the moment. Yields elsewhere higher on a 10-year by 9 or 10 basis points. 10-year Treasury. Yields have been all over the place, Tom. I'll give you the range. Just let me give you the range on a 10-year Treasury, never mind the gilt market. 4%, the high yesterday, 4.01%. The low was 369. Tom, there's quite a range on a morning where we didn't really have any data.
And I distilled this down to the real yield, which was a 1.60, comes back to 1.50. I thought Zero Hedge last night in the 4-hour, John, did a great job of regaming the bet on what the Fed will do. And I think that's underreported this morning, John. There's been an adjustment in the market of what the trajectory of the Fed is.
Tom, it's the conflict between tackling inflation and preventing financial stability risk. The Bank of England captured that perfectly yesterday, and that's what Mohammed addressed. You've got a Bank of England on the one hand buying gilts to try and preserve financial stability, and on the other hand, it's set to raise interest rates, perhaps aggressively, over the next month or so, Tom. So which one wins out?
Right. We digress right now as we have to. If you are a Red Sox fan, and maybe you were ever so lucky like me, you saw Ted Williams on the backside of the career after his public service to the nation in not one but 2 wars. Anne-Marie Horton and a select group of Bloomberg surveillance community, including Douglas Cass in Florida, are watching Primetime with a kid from Fresno State. Anne-Marie, what was it like as someone that's followed this kid forever to see number 61 last night? For radio, I must note that Miss Horton is wearing the Yankee garb this morning.
Yeah, I had to wear this, Tom, just to troll you this morning because they're having an incredible season. And everyone has just been waiting for him to hit this home run, and he did it last night. He gave the ball to his mom. An incredible moment. It really is an incredible moment. It's incredibly hard to do, and he's able to do it. And Roger Maris's son was also there.
Yeah.
So.
I thought Roger Maris's son, after what I witnessed as a child, was a total class act. Should we see, to bring it over to your day gig, should we see Mr. Judge greeted by the President of the United States?
Oh, I would love to see that, wouldn't you? That would be amazing. I hope that in that case,
John,
our
she would
Bloomberg
be
News
so
colleagues would let me go in for the
John,
Oval Office for that one.
It would be so embarrassing.
Tom, 6'7", this guy's just a monster. I've watched him live a few times. 6'7", 282 pounds. And Tom, when he steps up to the plate, it is just phenomenal how big he actually is. It's just ridiculous.
It is the size, but it's also the mechanics and the grace of it as well. I had the great privilege of the first time I saw him, I was literally 2 feet from the on-deck circle, and it's shocking, John, the grace that goes with the size. We'll move on here, Liz. We look for number 62 from Mr. Judge here in a moment. Anne-Marie, I want to talk about the president. Greg Valliere wrote a painful note this morning on the state of a near 80-year-old president as well. This is delicate. These are delicate issues. How's the president doing? How does he get through each day?
Well, it's getting really difficult, right, in the sense that there's a lot on the president's plate and they're gearing up for midterm elections, so the events keep coming in. There was obviously a delicate, as you say, but an embarrassing moment for the president yesterday when he was calling out a congresswoman, a late congresswoman's name, thinking she was in the room, and obviously she had passed away in a fatal car accident last month. And then the White House way they spinned it was that this individual was just top of the president's mind. Obviously, mistakes like this can happen. You don't know what was written in the teleprompter and the likes, but it does draw criticism to a president that when you also look in the polls, most Democrats are saying do not want him to lead them in the 2024 next presidential election.
Right now, Anne-Marie, my focus is less on that political back and forth and more on what's going on with Florida. And the reason why is from a political standpoint with Ron DeSantis coming out and actually having to ask for aid from a president who he might run against and has been pretty vitriolic against. And also this question of what to do at a time when we have massive population very much at the forefront of the hurricane risk. What's the message right now from the White House?
Well, the White House is making clear that they are behind the leaders in Florida in terms of any of the funding, any of the support that they need. The president has been calling a number of mayors throughout Florida and also has gotten on the phone with Governor DeSantis. And obviously, when you have natural disasters like this, for the most part, politics is put to the side, right? And this is about making sure that FEMA is in place. The president this afternoon at noon is going to be at FEMA headquarters. He's going to get an update on Hurricane Ian because right now, yes, it has been downgraded to a tropical storm, but the damage it has done is incredibly destructive. And on top of that, at this moment, more than 2.5 million businesses and households are in the dark. So this is obviously going to be incredibly important for the president, and how he handles this also can maybe impact, you know, one of these lasting moments before voters go to the polls.
Washington Post with a great chart on the population growth on the west coast of Florida over the last number of years. Anne-Marie, a viewer, a listener, the famous Bramo emails in. Bramo says Judge looks good as a Met. I just want to make that clear. I mean...
Also, we have to note, this guy is a team player. He wasn't swinging at everything over the past 5 or 6 games just to make sure he can hit 61. He wanted to get... Yeah, he's about winning.
Right.
I was getting messages every time he was stepping up to the plate, Tom, over the weekend. From Anne-Marie. Every single time. Put it on, put it on.
Anne-Marie? If he's about winning, then it's good to go to the Mets because they're winning right now. Just saying, theoretically.
Thank you for weighing in.
I can see a rivalry emerging here between the two of you through the rest of the season.
I just can't get over Lisa, Upper West Side. How does she become a Mets fan?
Really?
How did that happen?
It's a long story. Not particularly, but I will. But you know, first of all, it's nice to root for the underdog, then see the underdog win, and people say, "Oh, you're just getting on the bandwagon and saying, haha, I just won."
There you go. Are we done?
Please, let's be totally done.
John, we've had so much football time for the last 10 years that you can have a little bit more baseball time.
It's all right. It's a lot going on.
AMH, down in DC. It was a delicate moment yesterday for the president, Tom. Really delicate. And then the press briefing with his press secretary. I have to say, that didn't go too well yesterday, TK.
Really delicate, and just major kudos to Greg Valliere for raising the dialogue on such a delicate issue. Valliere's note this morning from AGF is just gentle, it's elegiac.
Futures right now down 0.9% on the S&P. Carl Weinberg at 5 Frequency Economics joining us very shortly. Looking forward to that. Live from New York, this is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Live from New York, equities lower. We're down 1% on the S&P 500. On the Nasdaq 100, we are negative 1.36%. Big day of gains on Wednesday. We take some of it back this Thursday morning. In the bond market, all over the place. Wild couple of weeks in the bond market. Yields higher again by 10 or 11 basis points on a 10-year. 383.80 on 2s, up 8 to 421.50. Elsewhere, sterling very much in focus. Liz Truss, the British Prime Minister, standing by and defending her latest policy shift. Cable, Tom, back to 108.48, down about 0.4 of 1%.
On a technical basis, range bound, and we'll go with that. We'll have to see, based on the news, what happens this morning. Thanks to Mohamed El-Arian just moments ago, bringing to my attention renminbi appreciation this morning, maybe some form of ballet there as well. Right now, with the ballet outside the Bank of England in London, Lizzie Burden joins us. Lizzie, I think the British press is doing a much better job of this than the global financial media. The Prime Minister needs to, quote unquote, address the nation. How is she doing on that this morning on local radio?
Well, I think it's Liz Truss's choice to go around the local broadcasters and speak to them. Some would argue that she's dodging the difficult questions from financial journalists. If she wants to speak to markets, she should come and talk to us. But at the same time, there's a lot of defense of local radio, and they do seem to be doing a pretty good job. Some of them, well, there was an interview in Leeds where she was asked how she slept last night. She was told all the things that have gone on in recent days, and then she was asked, where have you been? So they do seem to be doing a pretty good job of putting pressure on her. Her answer has been, I believe in my tax cuts and we need to keep going with them. That is not going to reassure financial markets.
Lizzie, do they understand why financial markets were whipsawed in the last couple of days? What are they blaming that on?
I can't say whether the government understands it. I actually spoke to the Shadow Chancellor, Rachel Reeves, at Labour Party conference earlier in the week, and she seemed to have a very clear understanding of the impact of the gilt markets on not only the government but ordinary people. But the whole point of this was the government thought that because it had a relatively low debt to GDP ratio, it could get away without scaring off the markets. But what the markets have objected to is, first of all, that these tax cuts are funded by borrowing, and secondly, that there was no fiscal forecast from the Office for Budget Responsibility alongside them. They do seem to have acknowledged that problem, because now they've said, the Treasury has said, on November the 23rd, we will get that economic assessment.
Lizzie, thank you. Lizzie Burden there from outside the Bank of England. I just wonder if they can all wait this long. November 23rd for the budget, November 3rd for the Bank of England, and Tom, we're not even in October yet. That month is going to be a very very long month.
I don't think they've got a month, John. How about a week? What are they going to do in the next week, John?
Well, the Bank of England's operation they announced yesterday, Tom, only goes until the middle of October.
If we had this issue here, it's unthinkable that any given president would go out to local radio to begin to discuss this with the nation flat on its back. I find it, I guess surreal is the right word. Right now, and this is a joy as we continue to bring in, to gather in people, as John mentioned, Dr. L. Arian, Jens Nordvig with us yesterday. I thought Alan Ruskin was wonderful with Deutsche Bank. Right now, Carl Weinberg, Chief Economist, High Frequency Economics, and far more out of the Lawrence Klein wing of the University of Pennsylvania with real-world work in the rooms as these things get worked out. Carl, you nailed it this morning by saying, look, it's liquidation of bonds for cash. How will politicians respond to the threat of liquidation of bonds for cash?
Well, I think, good morning, Tom. Thank you. I'll try to live up to your introduction. You know, what government can do is the government can give people a better reason to hold bonds, a prospect for thinking that inflation will come down and that'll bring down bond yields, a prospect for thinking that the public finances are stabilized, that'll bring down bond yields, a prospect for thinking that once inflation is under control, then growth will be able to resume, that'll bring down bond yields. But right now, we're not getting any of that in the UK. At least not in the judgment of the markets, as we're plainly seeing. And whether it's right, wrong, good, bad politics, it nonetheless seems to be the market's reading it as bad economics.
And how much is the Bank of England's response kind of the playbook for a lot of central banks going forward in terms of both hiking rates, keeping the front end high, and buying bonds to basically monetize a fiscal response, to monetize what the policymakers and government are going to be doing without completely upending the economy?
Hi, good morning, Lisa. That's all the right questions, and it's hard to know what the answers are. The Bank of England has done a good job of convincing everybody that inflation is rampant. And whether I agree with that or not, all right, that's what the market believes, and that's what the market expects. So having convinced the public, having generated expectations in the public that there is a true inflation problem and that the right answer to that is hiking rates, the Bank of England really has no choice but to continue to deliver the remedy for the problem that it's defined and continue to raise interest rates. And it's going to have to raise them by a lot. If you look at their own inflation forecast, which again, they aim to convince us are accurate forecasts, right? Real interest rates are nowhere near real positive, all right, let alone high enough to break the economy. And now add to it the fiscal stimulus. They have to, in order to deliver the promise, in order to play out the scene that they have set, they have to deliver much higher interest rates. And it won't be until they do, I think, that the market will find an equilibrium price.
Carl, have we reached the limits of deficit financing?
Well, certainly in the case of the UK, we have to say that the market isn't buying what the government is selling in terms of the amount of debt that it believes it can finance at this time. You know, in the longer term, you know, we're all dead, of course, but in the longer term, we can probably borrow a lot more than we are right now. But to amp up the game at such a rapid pace under these current circumstances, which is to say in opposition to the stated policy goals of the central bank, ignoring, if you will, the advice of the central bank governor and his committee and his economists and his analysis, all right, and going ahead and ramping up spending anyhow, that seems to be a move that pushed beyond credibility.
Carl Weinberg, September 1982, and of course Daniel Yergin wrote this up beautifully in Commanding Heights. You were at the Bank of Montreal doing debt workouts on disasters in Latin America. What does Trussonomics 2 look like? How do they get from what everybody believes is a theoretical train wreck to whatever the outcome is? How do you get to Reaganomics 2? How do you get to Trussonomics 2?
Well, Thomas, I'm sure you've mentioned many times over the last couple of days, the Reagan administration cut taxes like mad and ran up the federal deficit like mad in the early days of its administration. But by the time we got to the end, they were raising taxes to pay for it. And all of the promises of supply-side economics and voodoo economics, or whatever you chose to call it, didn't seem to work out. So I suspect that someday there will be a day of reckoning in the UK where they will have to unwind some of this. But it's pretty clear from the Prime Minister's statement that that's not going to happen this week or next week or the month even after that.
We got to continue this. John Farrow, jump in here. You're the guy from Britain as well. What does the 1922 committee do under your odd government in Britain?
Well, I think the market's going to dictate that, Tom, potentially over the next few weeks. And Carl is right. For the next few weeks, at least, I think a lot of people don't see Liz Truss changing her mind. At the moment, Carl, this operation from the Bank of England goes until the middle of October. The concept we're all talking about now, Carl, is fiscal dominance. Walk us through that concept, Carl, and how well you think this Bank of England can push back against it.
Well, the Bank of England, John, as you know, has unlimited resources. It can raise interest rates to 1,000,000% if it wants to achieve its goals. It's said what it wants to do. It's said how it's going to do it, and I don't think it can or will back down. On terms of the government has limited fiscal resources if it gets into a battle with the Bank of England over whether the economy should be stimulated or not. The Bank of England will win this. It's a question at what interest rate do we have to get there. The risk, the big risk, and John, I know you're conscious of this very much more so than I am, is that the government gets fed up with the Bank of England and starts to restrict its independence.
Yep.
On that day, sterling will go down the tubes, and on that day, gilt yields will soar to levels that I dare not even contemplate.
There was a whisper of that in August, and they tried to address it as soon as they took over. Carl, fantastic to hear from you, sir, as always. Carl Weinberg there of High Frequency Economics. There is conflict across the board. There is conflict between the Federal Reserve and the rest of the world as everyone tries to grapple with the FX market and try and achieve a stronger currency. There is conflict within the United Kingdom, within the UK, between fiscal policy and monetary policy. And as Mohammed pointed out in the last 24 hours, there is now conflict within the central bank as they try and achieve financial stability and bring down inflation at the same time. And Tom, that's the thing we've got to sit on just a little bit more. How do you preserve financial stability coming into the gilt market and buying bonds, and at the same time address inflation, hike interest rates by potentially 100 basis points? That one, I can't reconcile.
What Alan Meltzer would say, and this conundrum has been there, John, since the advent, let's call it 1907, 1912 Fed central banking. But the conundrum here is real simple. Time is the friend of policymakers. And as Weinberg predicted for Greece, he was 2 years out front with a lot of other people, John, as well. I think, John, you worked that out as well as Dr. Weinberg. But the bottom line is time is your friend. And Truss has to understand that her solution to her winnable policy is to extend the x-axis out. That's not what we're seeing now. Here it's all at once.
To wait. And Tom, I think you're not alone saying that, Tom. Yeah. A lot of people have said that perhaps this policy might have been the right policy in maybe 9 months' time, 10 months' time. But right now, what was the word that Guy used yesterday? Febrile markets. Talks about maybe this was the wrong time to use it given the market backdrop. Yeah, that's some fancy British word.
I don't understand what that means. I can't keep up with Guy.
I can't keep up with Guy either. He's fantastic.
He's posh.
I try and keep up.
He's posh.
He's posher than I am, that's for sure.
Very posh. Look, what do you see on the screen, John? I mean, seriously here, folks, we're in the middle of a crisis. It's Wednesday. We got claims coming up tomorrow, some economic data today. And, John, I still got to go back to the litmus paper of the system. Sterling is not broken out to sterling strength 108 level.
Yields are still all over the place. And, Lisa, you started the program talking about this. You've got global core government bond markets trading like crypto.
Actually, trading worse than crypto was what we learned earlier
from
this
Dean
morning.
Kernet, yeah.
From Dean Kernet.
Futures down 1%, live from New York on TV and radio. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. One of the strongest hurricanes ever to hit the U.S. has now been downgraded to a tropical storm. Ian has devastated parts of Florida, flooding homes and knocking out power to more than 2 million people. It's expected to be one of the costliest storms ever, causing more than $67 billion in damages and economic losses. The storm is forecast to move across central Florida and emerge over the Atlantic Ocean later today. The U.S. is now seeking ways to encourage British Prime Minister Liz Truss's team to dial back those dramatic tax cuts. Bloomberg's learned that the U.S. Treasury Department is concerned about the volatility in the financial markets. It's working through the IMF to put the pressure on the British government. Russia's President Vladimir Putin is pushing ahead with the annexation of the parts of Ukraine that its troops control after sham elections. And that puts the Kremlin on another collision course with the U.S. and its allies. Russia will sign treaties to absorb the 4 regions at a ceremony on Friday. Retired Super Bowl quarterback Eli Manning has scored his first private equity deal. The firm where he's a partner, Brand Velocity Group, has acquired a majority stake in youth sports league apparel company Score Sports. A group of current and former pro athletes also invested. Bloomberg's learned the transaction values the business at about $145 million. And in baseball, Aaron Judge of the New York Yankees hit his 61st home run Wednesday night. That tied the American League record set by Yankees Roger Maris in 1961. Judge's success could help him negotiate a new contract when he becomes a free agent after this season. He reportedly turned down a 7-year, $213 million offer from the Yankees. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Is it possible the industry is in an arms race that will lead to spending itself into an oversupply? I mean, that has happened before.
We've looked at this very carefully, and the digitization of everything. Tell me what aspect of your life, Emily, isn't becoming more digital?
Well, I'm trying to prevent that, but yes, I think it's happening.
And COVID has accelerated that. The industry crossed $500 billion last year, the semiconductor industry overall, and estimates are $1 trillion, a doubling by the end of the decade at that point. I believe those estimates. It's not that there's not going to be some blips and turns on the way, and the majority of that is driven by leadership process technology, of which only 3 companies can satisfy that need.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
was aware and is aware of the contagion effect of monetary policy. But again, that won't be enough to deter this Federal Reserve from their current pathway, as their focus is reining in inflation and reinstating the bedrock of the economy, which is price stability.
Until something cracks. Perhaps. Lindsay Pieksa, chief economist at Stifel, live from New York. This is Bloomberg. Equities are lower by 8 or 9/10% on the S&P. On the Nasdaq 100, down by 1.2%. Yields are higher by 9 basis points on a 10-year, 3.8218. For those of you interested in where the gilt market is trading, which seems to be how we're playing this at the moment.
Yeah, how is it?
I can tell you at the front end, it's up 20 basis points on a 2-year. At the long end, we're down a couple of basis points. We are all over the shop. Tom, there is a clear split in the gilt market right now. If you look from 2s out to 50s, between 30s and up. So 2s to 10s are softer, yields higher, and then all the stuff that the central bank is buying in the gilt market operation, which is the longer stuff,
right.
The 30s, the 40s, the 50s, pretty stable. That's the split. It's pretty clear on my screen right now.
We'll continue to monitor this, and of course, off of our credit desk in London as well. John, quickly, surveillance correction. John, senior moment. I mean, President Biden's have some challenge as well. So is President Keane. Surveillance correction. Sure. I thought it was Wednesday the whole day.
Oh, did you?
Do
you feel happier now? You know, it's Thursday.
Yeah, we've got an American Indian in our control room, Treon House, and she said to me gently that Treon House said, Tom, it's Thursday.
It is Thursday, Tom.
I nailed it.
Still September.
Claims coming up here in less than 2 hours, and they will be important. This is an honor. She is Ukrainian, and that means something different when you're at the Atlantic Council. As Deputy Director of European Energy Security, Olga Krakova joins us with bulletproof effort on environmental pipeline work. She is definitive out of the University of Kansas. Olga, honored to have you with us this morning. There's this pipeline, there's that pipeline. Can Russia go out right now and blow up any damn pipeline they want to?
Well, hopefully not. And every effort right now, all the energies at NATO level, US, EU, wider European cooperation is being focused to make sure that that does not happen. Greater visibility on what those threats are, both kinetic and cyber, because both are at risk right now. Having a clear assessment of what's happening with the critical infrastructure, identifying exactly what that critical infrastructure is and what's more or less likely to be attacked. That is exactly what the allies are focusing on right now.
What's going on? Why would Russia, we were talking about this before coming on, why would Russia sabotage the Nord Stream 1 pipeline? It's unclear if they did. We haven't gotten that confirmed. There were hints of that from authorities. And then we had some ambiguous comment out of the Kremlin today saying that it could be state terrorism. What's going on?
Right. Definitively, we do not know for 100% that this was Russia, but everything is pointing to Russia. And initially, when I first saw the headlines, I had to take a few seconds and think, why would Russia destroy its own billions of dollars worth of infrastructure when, on the other hand, it is pushing to have more gas flowing through Nord Stream 1, through Nord Stream 2, through reducing sanctions. But if you look at the bigger picture, right now, nothing is moving through Nord Stream 1, Nord Stream 2, so they're not really losing any income on the gas moving through the pipelines. Russia is also creating this market uncertainty and, once again, spiking up prices just when the prices started to come down as Europe was filling up its storage. And it's getting up to 90+% across a lot of the countries. So there was, the market was slowly easing into the winter. Now, it was still going to be a rough winter, but the prices started to level down. Now, with these recent explosions, we're seeing the prices going back up, and this is not because of the supply crunch. Once again, Nord Stream 1, Nord Stream 2 did not have any gas flowing through it. So and Russia can still increase flows through Yamal and other Ukrainian pipeline networks, as well as through Turkey. So the alternative is there. And the reason the markets are reacting the way they are is because, to what you asked earlier, is that risk on critical energy infrastructure across Europe.
One of the hardest equations right now, Olga, is extrapolating the energy story into the economic story in terms of how much slowdown there's going to be. Germany's network regulator today came out and said that gas demand was well above last week. Temperatures have been dropping. You're starting to see the winter effect come into play, and that there needs to be savings of 20% to avoid some sort of shortage this winter. What does that look like? How much have people really accounted for the slowdown of idling factories and unheated stores in order to save that energy?
Right, and a lot more will have to be done. So just to reiterate, the storage, being full is one of those things that's going to make sure that people will be okay. People are not going to freeze to death. But going back to your question on the economic impacts, that's still going to be extremely tough on a lot of the industries that are carbon intensive and are utilizing natural gas to produce whatever they're making. Whether it's and Germany, most of its economy is heavily reliant on their industry production. So further cuts will need to be done. Sacrifices such as, putting your thermostat at a level that you may not be comfortable at. But once again, looking into what can you weatherize in the next couple of months to ease into that. Now, Germany also has quite a few 5 FSRUs coming in online in the next couple of months and also in the next year or so. So they are looking into alternative options, alternative supplies, but there's only so many options in what can be done in the next couple of months, and it will be tough, and it will be extremely tough on the economy.
Olga, thank you. A difficult winter ahead. Don't know how many times I've said that already. Olga Kukova there of the Atlantic Council, and it's not winter yet. CPI out of Germany, we had the regional breakdown a little bit earlier this morning. The numbers, Lisa, not pretty. In some regions, double-digit inflation in Germany again. I believe the headline number comes out in about an hour's time, and we could see a big number there too.
Yeah, some people extrapolating out a 10% figure, which would be the biggest in data going back to the 1990s. No, I can't. This is a country that has really structured itself around not having inflation. And they're facing inflation of the absolute worst kind through commodities, through slowing growth. How do you deal with that? I mean, honestly, this is going to be just a game changer when you're talking about electric blankets flying off the shelves, because that's how people are preparing for a winter that's going to be really tough.
The theme of the last 24 hours, and the UK has experienced it, is the difficulty addressing inflation and preserving financial stability. Tom, if we get double-digit CPI out of Germany, you're going to have a monster push to do more. We heard from one ECB official earlier this morning to do something about QT. At the same time, we've got an Italian 10-year just short of 470.
This is really important, John. Lisa nailed this early in the show this morning. This is something not only in Germany, but frankly in the United States, folks, is if we get inflation not giving way, particularly core CPI in America, Germany here in what, John, an hour and 5 minutes. I mean, that's just another indicator of the front loading that's required right now.
Yields up in Germany, and inflation could well be up as well. We'll bring you that number in about 60 minutes' time. Going to catch up with Sebastian Page in just a moment, the CIO and head of global multi-asset at T. Rowe Price. Looking forward to catching up with him. Futures right now, off the lows, down 0.8% on the S&P. On the Nasdaq 100, down by a little more than 1%. A 10-year yield that is higher by 8 or 9 basis points again on a 10-year 381.78. Lisa, we've talked a lot about that range, haven't we? That range has been huge in the last 24 hours. Not quite gilt-esque. I'll admit that, but still on a 10-year, pretty impressive.
Yeah, but gilt-esque means more volatile than Bitcoin, as Dean Kernet said.
Nuts.
So, I mean, this is a pretty high bar there in terms of volatility.
From New York, this is Bloomberg.
Today, what is the biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Such an interesting new world. The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
If you're not really in that space full time, I think it's very hard to run a successful crypto fund.
In a $7 trillion industry, there's a lot of ground to cover.
Prepare for an economic hurricane.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg.
I think the Bank of England's been backed to some extent into a corner by unorthodox fiscal policies.
The BOE really needs to keep a hawkish eye on inflation and in controlling inflation.
Markets aren't stable, inflation changes everything, and governments, central banks are going to try all kinds of things.
Global markets moving 20, 30, 50 basis points off of one data point. I think that in and of itself is an indication of dysfunction.
Today, we're seeing, the economics of pandemonium.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What happens when the bond market is trading like a penny stock? From New York City this morning, good morning for our audience worldwide, live on TV and radio. This is Bloomberg Surveillance with Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures down 0.9% on the S&P. TK, this bond market in the last 24 hours, all over the place.
This is an historic moment. I really want to emphasize, John, it continues today, more nuanced, maybe not the fire that was evident yesterday, Wednesday, or Tuesday as well. But, John, there is some real tension in the market, but I would link it over to everyone hanging on every 2- and 3-word syllable word from the Prime Minister.
From the Prime Minister and the Governor, perhaps, of the Bank of England. November is a long way away. November is a long way away. We've got to wait for a budget in November, got to wait for a Bank of England decision in November. My question, Tom, would be, do we have to wait for those two things?
I would say not. And what I see, and if folks, I don't want to do the inside baseball here at the top of the hour. We've got a lot to accomplish. But I would say, John, that I would watch inflation-adjusted yields, and I would watch what Lisa watches, the spread market is the almost thermometer of the belief in what Jerome Powell would do.
Lisa, the conflict is there for all to see.
And right now, the conflict is also in the hidden leverage that's been built up around markets that were considered risk-free. And you asked earlier this morning, John, how much is this a problem that we're seeing the risk in risk-free assets? And I would argue a massive problem. That is what is the cause of financial crises, because of things like pension funds that have sort of hidden leverage to the longer end of the curve in the United Kingdom.
Nuts.
How many bailouts can you actually achieve given some of these structural issues?
Up the critical question. Mohammed Al-Arian asked that question for us in the last 24 hours. Can you tackle inflation and address financial stability simultaneously? Had a flavour of this from the ECB earlier in the summer. Now we're seeing it play out in the UK. Can you?
It's really tough without cooperation from the physical world. If you don't get a cooperation in some sort of year-over-year comparison in inflation, if you don't understand the root cause, it becomes a serious challenge. In other words, can central banks continue to hike the front end while buying bonds, while engaging in mass quantitative easing programs, essentially, on the back end, tightening and easing? We're going to Japan.
At the same time.
Yeah, this is Japanification in a new way.
It's crazy stuff. Equities this morning. Good morning to you. We are lower by 0.9% on the S&P. On the Nasdaq, we're down by 1.2%. Yields are higher again by 9 basis points, 382.38. Dollar showing a little bit of strength, Lisa, against the euro. Euro dollar 97.13.
And right now, what we're seeing is intervention on a global scale, unlike what we have seen for decades. And it comes on the heels of inflation that we have not seen for decades. 8 a.m., we get the latest read on that German CPI coming out. The expectation is it could be 10% on average, a record. How do you deal with a nation who has not seen this since World War II, this type of inflation? The whole structure of the economy was built around avoiding this, not spending too much, and now spending more to try to stave off some of the pain of high energy prices. The conundrum is felt around the world. 8:30 a.m., we get U.S. initial jobless claims, as well as the third read on the GDP, annualized personal consumption, core PCE for the second quarter as well. Tom, you were talking about claims Thursday. How much do we actually get an accurate read on the labor market? And what you're hearing more from some of the reports from economists is looking under the hood and seeing weakness, more households that are taking on more jobs, companies that aren't necessarily hiring as much, just shutting out some of those openings, or possibly reducing the hours of different employees. This is a different and nuanced picture that's moving very quickly, and we can get possibly the underpinnings of that with some earnings with Bed Bath & Beyond at 7:30 a.m. in about a half an hour time, Nike after the bell, the retailers, and Micron Technology really speaking to some of the fall off in demand for chips.
I would take it and push it aside. The financial stability questions now have they're rendered supreme on this Thursday.
I'm with you, Tom. Lisa is too. I think we're all on the same page on this in a major, major way. Lisa, thank you. Sebastian Page joins us now, CIO and head of global multi-asset at T. Rowe Price. Seb, let's start there. Can you address inflation and preserve financial stability at the same time?
Jonathan, it's very hard. It's like having a foot on the brake and a foot on the accelerator. Think about what's going on in the UK. You're printing money by buying long-end bonds while you're tightening interest rates. The problem, and you've hit the nail on the head already, is financial stability. And look, one of our analysts sent me overnight an analysis that suggested that if the BOE hadn't started buying those 30-year gilts, about 90% of LDI, liability-driven investing pension managers, would have run out of collateral. So we're really talking about financial stability here, and everyone's criticizing this foot on the brake, foot on the accelerator. It doesn't make sense. It's crazy macro policy. But at some point, Jonathan, I think the takeaway is it's not whether it can make it work or not. It's you have to do it. You have no choice.
Sebastian, out 3 years. T. Rowe Price, 5 years is short term. We all know that. Does this imply that central banks will blink, that we will impute a permanent inflation into the system, which will give us a better revenue stream, which means equities become more attractive?
Not quite yet. And again, we're still trying to tighten monetary conditions. I don't think that this forces a Fed pivot anytime soon, but you'll have to try to do both, Tom. And I do think that the stickiness of inflation is going to persist. I've been coming on your show for a while now this year saying, we're underweight stocks. We're getting there. We're going to start buying soon because we like to be contrarian, but just not quite yet. And today I'm still saying just not quite yet. And part of it is the last inflation print in the U.S., 0.6%. month over month in the core CPI with increases in rents and housing. And so it's really sticky. Now, the craziest number in capital markets to me is the 1 year break even, right? It's actually below 2%. Now, my friends who are economists tell me, don't look at the break even as inflation expectations. It's technical, it has a risk premium component and so on. But look, one of our asset allocation committee members said at our last meeting that if we print 2% year-over-year inflation 12 months from now, they're going to eat their hat in our committee meeting. So that number, that one-year break even, looks out of place to me. Tom, short answer, inflation is going to be sticky, and I think we are in a new world for inflation.
Sebastian, bear with me with some mental gymnastics, but I'm trying to do some mental gymnastics with the idea of buying bonds and raising rates at the front end. But doesn't the unwillingness to allow the market to crash, to allow financial stability to unravel, prolong inflation by monetizing a nation's debt?
Yes, I think it does. But again, you have very little choice. And this is sort of the third leg of the risk in financial markets that we are just starting to see. And you've been talking about it on the show today. You're just starting to see it, right? We've had the rate shock and the repricing of stocks, and stocks are down 20%. Everyone's worried about the growth shock, in which case, by the way, long end government bonds should do okay. They should be a hedge for a growth shock, not for a rate shock, but for a growth shock. And the third leg, which we're all worried about right now, and maybe that's why we're not leaning in right now to go back to neutral on stocks versus bonds, is the financial stability, the plumbing. And think about the COVID experience in March 2020. Authorities, the Fed, you had no choice but to get in and solve the plumbing issue, because we're talking about systemic risks. So yes, I think it will overall make the fight against inflation much more difficult. And it will also mean that over time, the tightening is going to have to be persistent, at least for the next 12 months. So it's everyone's bearish, Lisa. Everyone's come around to your view, right? And look, I think it's very hard to make a bullish case right now. I played devil's advocate with our asset allocation committee, and I basically showed data that doesn't look at all like pre-recession. Year-over-year consumption in nominal terms. Earnings surprises, leverage much lower, PMI levels are actually still above 50. So if you compare those data to March 01 and December 07, you're not in pre-recession level. But again, everything else is just so bearish, and the financial stability is becoming an issue. So these are treacherous markets.
Sebastian, I'm Lisa's agent, and she does consultancy if you want someone to play devil's advocate on the committee. If you've got a spare chair.
Because that's what I do by profession.
It's a big rate, I'll tell you that. Sebastian paid a T-row price. Go on, Seb, just find it quickly. Go on, Seb.
Thank you. Well, the devil's advocates are really hard to find on the bullish side right now. I think even Laidler, Kalanovic, you have them on your show. They're struggling to make a strong bullish case right now, right? But at some point, this is price. It is the most anticipated recession in history in my mind.
I'm not sure Lisa's the right candidate for the bullish side.
I actually
read
something.
The bullish side?
There was a bullish commentary out, not just from Marko Kalanovic, but saying basically that we've had such a washout of sentiment that it's starting to look like a lot of the bad news has been priced in. But that's as good as you can get in terms of optimism.
The Fed pivot is the thing they're all excited about on the bullish side. The struggle I have with that, Lisa, if they're pivoting because of recession, and by pivot I mean pause, because of recession or financial stability risk, is that bullish? I don't know if that's bullish.
Forgive me for the second and third derivative here.
Sure.
But what that means is longer term inflation.
Oh, exactly.
What that means is rates higher for longer. What that means is the long end having trouble staying moored, because that ends up with them not seriously fighting that issue. This is not an easy or comfortable situation for risk assets.
Futures down 8 or 0.9% on the S&P 500. On the Nasdaq 100, we're down by a little more than 1%. Yields are higher by 9 or 10 basis points. Just getting information from the White House. The president approving a Florida disaster declaration. We'll bring you the latest from down in Florida very shortly. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, Ian has been downgraded to a tropical storm after coming ashore in Florida with a deadly surge of water and catastrophic winds. When the damages are added up, it's expected to be one of the costliest storms in U.S. history. About 2.3 million homes are without power, and the storm is forecast to move across central Florida and emerge over the Atlantic Ocean later today. It's expected to approach the coast of South Carolina on Friday and then move inland once again. British Prime Minister Liz Truss is defending that package of tax cuts that sent markets into turmoil. Truss told local radio stations in the UK that the UK is facing difficult economic times, and the government had to take urgent action to get the economy growing. Despite the collapse of the pound and a surge in borrowing costs, the trust says she's confident the government has done the right thing. Russia's President Vladimir Putin is pushing ahead with the annexation of parts of Ukraine that its troops control after sham elections. That puts the Kremlin on another collision course with the U.S. and its allies. Russia will sign treaties to absorb the 4 regions at a ceremony on Friday. And OPEC Plus has started talking about cutting oil output when it meets next week. According to a delegate, the size of the potential cut is still under consideration. The fragile global economy continues to put pressure on oil prices. At its latest meeting, OPEC Plus showed its readiness to stabilize markets by making a symbolic cut. And Porsche has gone public. Shares of the sports car maker began trading today after Europe's largest IPO in a decade. Parent Volkswagen raised more than $9 billion, pricing the stock at the top end of the initial range. The offering valued Porsche at $73 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else. It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
No one covers the world like Bloomberg.
Russia will then absorb these territories. What is NATO's reaction?
Italy's Giorgia Meloni wins a clear majority, ushering in the nation's most right-wing government since World War II.
The Fed offers no sign that it is ready to stop tightening.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Federal funds rate next year would increase to 4.5 to 4 3/4. I think it's pretty clear that everybody has in mind a continued increase until we get to that point. I'd say like March 2023 we'll be at that point.
We'll see. I think Tom's been saying it a million times. OBE overtaken by events. Charles Evans there, the Chicago Fed president, at an event hosted by the London School of Economics. Futures right now down 0.6% on the S&P, just about off session lows on the Nasdaq 100, down 0.9%. Again, yields higher by 8 or 9 basis points, 382 on a 10-year. I want to check in on the gilt market for you just briefly. I'll bring that up on my Bloomberg terminal. It's amazing to see the split in the gilt market at the moment. So basically, the Bank of England has this gilt operation now daily going out to the middle of October. And when you look at gilts, what you'll notice is that 30-year plus is trading firmer with yields lower, and then everything else, 10s down to 2s, is softer with yields higher. Now, Tom, that's because all the stuff from 2s to 10s is the stuff that the Bank of England's not buying at the moment in that gilt operation they announced yesterday.
What do we learn from Trust this morning, John? I mean, Lizzie Burden was
not much, Tom.
But the answer's not much, right?
There's some information in there.
I like that.
No change.
It's not much Thursday. Is that what we're calling it?
No change.
Yeah, no change. We're monitoring this, folks, and the litmus paper is sterling 108.75. I'm going to call that technically range-bound right now. On the lawn at the White House, Anne-Marie Horton joins us, Bloomberg, Washington correspondent. Anne-Marie, there is a hurricane. George Bush Jr. never recovered from a hurricane. Every politician. Give us the tension between the President of the United States and the governor of Florida. They're on the phone on this natural disaster, and other than that, they have nothing in common.
They have absolutely nothing in common, and it's not lost on anyone that these two could even go face-to-face potentially in a 2024 presidential election. So obviously things are tense. There's not been the nicest of words or politics towards the two of them, but they've put that aside. And what is going on in Florida? You have overnight the president declaring this disaster. He's unlocking these federal funds for loans, for housing, for anything that the state needs. And even yesterday, he was at an event last night, but he did start off talking about the fact that he wanted to give an update about what's going on in the hurricane. He wants to make sure that, and we've seen a number of these readouts, he's on the phone with mayors. If they're not picking up, he's leaving messages. That's one of what one of the readouts said. And then this afternoon, he'll be getting a brief on exactly the damage that was done, and that's at noon with FEMA.
Do you have any sense in your reporting of a federal policy to end lots and lots of development amid areas where there can be a natural disaster, whether it's a volcano or a hurricane, whatever? I don't detect a policy, do you?
No, I don't, and I'm not sure that actually would work for politicians, right? Especially when they're trying to talk about bringing back jobs and investment and building new homes, if that would actually work. But it does bring up a very good point, right? Because you have a number of these cities just absolutely flooded in Florida, and the way the world is going, what scientists say is that we could and should expect more of extreme natural disasters due to climate change.
Anne-Marie, this ties back to the conversation that we've been having, overcome by events, as Tom's been saying. The idea that nations have to actually be spending some real money to counteract real things at a time where money is much more expensive. How much can the United States spend the 70 billion some odd dollars that some people are estimating the damage to cost to repair, and still keep the rest of its budget? Because right now, it's not so easy just to expand and borrow more.
It's a great question because also at the same time you have a number of legislation that's come in over the summer that is going to be towards putting money towards investment, whether or not it was the Hard Inflation Reduction Act last summer or this summer, money going towards clean energy. It's a great question, but I think when it comes to things like natural disaster, you'll hear from politicians, you'll hear from this White House that they will do whatever it takes, in essence, to make sure that they can help people rebuild. But we do know, and we've seen that for years after Hurricane Katrina, people were still struggling to get back on their feet and get their homes rebuilt.
Anne-Marie, we appreciate the coverage. AMH down in D.C. She's going to keep us up to speed on this as the news continues to come in down in Florida. For everyone down there, we hope you're doing well. And stay safe, Tom, because as you know, things are difficult at the moment. And it takes a long time. It can take a few days, take a week for the damage to really reveal itself in places like this.
This is far worse than what I personally witnessed. Oh, I can't remember, John, 1990, whatever, Hurricane Bob. And this is not weeks, it's months, John. There is a fiscal impulse to rebuilding. There's no question about that. But far beyond that is just the permanent damage, and particularly the damage not to the fancy people that we talk to every day, but to people just making a go of it in the middle class of America.
Yeah, right now we need to talk about the markets too. Tom, we're going to come back to that story through this morning, of course, on Bloomberg TV and on Bloomberg Radio. Stocks at the moment down about 0.6% on the S&P. On the Nasdaq 100, down 0.9%. Talked a lot about the bond market. Yields higher by 8 basis points on a 10-year, 381.17. Talked a lot about the gilt market too. And Lisa, I'll keep bringing this up, just the split in the gilt market between what the Bank of England is buying and what it isn't buying at the moment in that gilt operation they announced yesterday.
How much is this operation save the housing market, operation save pensions? This is operation try to preserve a lid on just full chaos being unleashed in the UK market. A lot of people have been writing notes about how the UK is a front runner, not necessarily an outlier with respect to the conundrum of trying to deal with fiscal policies that can no longer be expansive purely on deficit spending alone.
I don't know if you save the housing market with this.
That's right, because it's short term.
Ultimately, rates are going to go up. Lisa, my question would be how much? I asked Mohammed that question yesterday, and he said 100 basis points, basically baseline, and perhaps even more.
And you've pointed this out, that the mortgage market is much more short term in the United Kingdom, and so it will go up more directly and more immediately with rate hikes. That said, then what point does that become a financial stability problem? If you get a housing market crash that's dramatic, well then how does the Bank of England really address that? And that goes to the question that Mohammed Al-Arian was asking. Are these two issues, these two goals, contradictory of both suppressing inflation and preventing some sort of systemic crash?
Oh, they're totally in conflict right now.
Yeah.
And not just in the UK. Tom, in Europe too. And really that's where it started, with the ECB talking about raising interest rates and then also talking about containing spreads in places like Italy.
Yeah, but within the nuance of the geographies, including everything going in the Pacific Rim, I would point out that they're still at war in Europe. I mean, that's the heart of the matter, is forget about the econ mumbo-jumbo. There's a war going on.
Energy supply. Yeah. Energy supply, top of mind, going through winter for the Europeans. Equities down 0.6%, yields up 8 basis points, 381 from New York. Jeff Curry at Goldman coming up very shortly. This is Bloomberg.